This is going to be the only video course that you need to retire early with option trading. Most people think that option trading is risky, but that's a huge misconception that only people who are new actually believe about options. If you actually know what you're doing, I promise option trading will be the safest and fastest way to generate consistent, safe, and passive income. I don't want to waste any of your time. Let's jump straight into it. In this free course, I'm going to cover literally everything that you need to know in order to generate pretty much passive income from options, no matter if you have a large portfolio or have a smaller portfolio or anything in between. I have a 7-figure portfolio, but this same knowledge applies to 5-figure accounts, 6-figure accounts, and beyond. No gambling, no chasing risky trades, no stress, just a steady stream of income that works for you, whether the market goes up, down, or sideways. The different strategies I'm going to cover are going to be either beneficial more in a sideways market or maybe an up market, and I'm going to explain each strategy for you. So make sure that you got out your notes because this is going to be life-changing information. On the screen right now and in the description on the video play bar are all the timestamps for everything that I'm going to cover in this course. Part 1, the path to retiring early with options. Now, before we get into these strategies, we need to talk about the biggest misconception that people have about retiring early and why most people do it completely wrong. See, most people are taught that the path to financial freedom is simply work a job, save a portion of your paycheck, and invest into the stock market. They hope that in 30 or 40 years, they have enough to retire. But let's be real, this strategy is outdated. Inflation eats away at your savings, and the market doesn't always go up, and relying on the 4% withdrawal rate, which is a safe withdrawal rate that many people talk about, well, that's probably not enough to live for the rest of your life, your dream lifestyle. That's not financial freedom. That's stress. That's waking up early in the morning, going to work, having a boss, and you don't have the freedom or the cash flow that you need. The truth is, retiring early isn't about how much money you have. It's about how much money you make per month. The cash flow is what takes care of you. If you can generate consistent, reliable income from your investments, you never really have to worry about running out of money. That's exactly what selling options allows you to do. It's very similar to real estate. You own a bunch of properties, they generate cash flow, you use that cash flow to live your life. You don't really care if the properties are worth billions or hundreds of thousands of dollars. You just care, what are you making per month? Is that enough to live on? And that's the most important formula that I follow myself to live the lifestyle that I live. Now, when most people think about options, they think of something really complicated or risky. They imagine some guy in a suit or basically someone staring at like 15 screens, making a bunch of trades. And that's not really true. You don't have to have 15 screens or look professional. In fact, some weirdos or some regular people or just your average Joe, doesn't really matter. I'm just trying to paint the picture that anyone can do it, even from a laptop. I've been traveling with just a laptop. You guys see a lot of my videos are basically filmed in a hotel. So the fact of the matter is, in this free course, I'm going to teach you how to keep it super simple, the tactics and techniques that I use, and how to scale your wealth without having to have multiple screens, without having to make it a full-time job, without any of the guesswork. We're going to talk about selling options because selling is really where the money's at. Sure, buying options can be really sexy. You can make a lot of money fast. In volatile markets, you can make hundreds of thousands of dollars. The thing is, you want to do this as a lifestyle. If you want to sell options and collect passive income on a monthly basis for the rest of your life that takes care of you, you need a formula, you need a process, you need a system. And keeping it simple means that you will have more longevity to actually do this, because let's be honest, most people start things and they quit them. But he who trades for a decade, you know that person is consistent. And selling options is really where everything changes. Think of it like this. When you walk into a casino, who makes money consistently? The gambler or the house? The house, of course, every time. Why? Because the casino doesn't gamble. It plays a probability in its favor. I'm painting the picture of the framework of how to think before we go into the strategies, because your mindset is just as important as the option strategies themselves. And we're going to be talking about managing the option strategies as well in this video. So look, selling options is the same thing. Instead of buying a lottery ticket and hoping that you win, crossing your fingers and maybe you'll get rich, instead just make a small amount of income basically because you have an edge. Make a consistent small sum of money that's predictable, and there you go. You at least know what you're making on a consistent basis. And from there, the challenge and the goal is to scale that and to make a little bit more every single month, to save more, to invest more, to find inefficiencies in the market, to find a better technique, to find the better support level, to find the better entry, to, make more profits. It's pretty straightforward, but It is a practice, just like doctors practice, lawyers practice, staying in shape and going to the gym. It's work. And the work that we do in option trading is only 2 hours per week. In my Discord community, I'm only trading 45 minutes 2 times a week. So I want to encourage you that this is not going to take a lot of time once you have the knowledge to do this. So this course is going to be teaching you to become the house or the casino and selling options for consistent income and being the one that collects the cash and then paying some of that out of the door in terms of some losses may occur. But look, it's like an insurance company. An insurance company always wins as well. Pretty much they collect a bunch of premium. Some people, need either health insurance or accident insurance, whatever. The insurance company pays some of that out, but they know that they're going to collect more than they're going to pay out. That's exactly how I trade option trading. The best part, you don't need to guesswork. You don't need to know where the market is going. You don't have to try to play the charts and predict them. We don't need a whole lot of technical analysis. You don't need to spend crazy hours looking at charts. You just need to know the strategies I'm going to cover in this free course that's going to absolutely change your life. So the 3 core strategies that we're going to be covering is selling cash secured puts, which allows you to get paid to buy stocks that you already want at a discount, selling covered calls, which lets you generate income from stocks that you already own, like collecting rent on a house that you own. And third, selling credit spreads. We're going to talk about 2 different credit spreads. These are phenomenal and very powerful for generating income, even if you have a smaller account. In all 3 of these, I'm going to talk about factors that really influence your odds and the probability of winning on all 3 of these selling strategies. With these 3 strategies alone, you can create a system that generates consistent income every single month without having to know 15 different strategies, without having to know too many crazy details. We're going to just break down and master 3 strategies, managing these strategies so you can create the income that you need. Now, I know what some of you are thinking, if this works so well, why isn't everyone doing it? Well, the thing is, not everyone has the capital to do it. Not everyone wants to learn option trading, and most people don't even know that this really exists. Schools don't teach it. The financial industry doesn't push it because, they'd rather sell expensive mutual funds and take fees. And financial advisors, which I used to work at Goldman Sachs in the financial advising department in Beverly Hills, where all of the celebrities are, they prefer to charge fees. And that's how the financial industry works. They make their money on fees. And retail traders, most of them are just too busy chasing risky stocks, day trading, or buying options, relying on their financial advisor. They don't take the most important step, which is learning to sell options. There is an edge at selling options. It's proven. And the reason, I'll tell you right now, the reason why option selling is so profitable is many large institutions, pension funds, hedge funds, they have to buy options. They buy options because they're hedging. That's why it's called a hedge fund. They're trying to hedge risk. Well, besides a market crash, which happens very rarely, once every 5 years, most of the time the market is going up, which means a majority of the time buying options and hedging makes no sense and it loses money. So instead of buying options and hedging, which sounds really smart and really cool, in all reality, if you sell options, you're going to be winning more than 95% of the time. Now, before we dive into the strategies, I need to make something really clear. This is not a get-rich-quick scheme. Selling options is powerful, but it's not magic. You won't go from zero to millionaire overnight. But what you can do is start generating consistent income month after month and growing that as your account grows and compounds over time, which is what I call getting rich slowly. And getting rich slowly, for me, I've gotten rich pretty slowly. It took me 8 years to become a multi-millionaire. And I would say that 8 years is not that bad, okay? If you have a pretty certain way of getting rich, I would follow the path that is more guaranteed than the path that is like get rich quick, maybe not, 40, 60, 20, 80, who knows, right? I'd rather follow the plan that has 95% certainty and go for lower risk, slower, but actually get rich at the end and actually hit the goal. So that's where the real power is, and that's what I'm going to be focusing on. So the most important goal that we're going to achieve by the end of this video, I promise, is you're going to learn how to cover your expenses and make more selling options so you can live without having to work and actually just letting your money work for you. You're no longer tied to a job that you hate, and all jobs suck, including my jobs that I worked in finance and on the streets of Wall Street, still very difficult. So if you're ready, now let's dive into all the details. So let's begin in the basics and then build up. What is an option? Because if you're brand new to this, you might be thinking, thinking, well, how does this all work? And that's totally normal. This part is going to clear things up for you, down to earth, very simple language and very little jargon. So even if you're a beginner, you can understand all the fundamentals. Let's break it down. An option is a contract. That's it. It's a contract between two people that gives one of them the option, but not the obligation. So that means that they have the choice to buy or sell a stock at a certain price within a certain amount of time. Think of it like a reservation. Let's say that you consider booking a 5-star hotel for 5 nights and each night is $500. And you're afraid that potentially the price is going to go up, but you're not really ready to pay the 5 nights times the $500 or the $2,500 upfront right now. You're afraid if you wait, the price is going to go up, and you've seen prices get up to $1,000, even $2,000 per night because this has been really popular or whatever, right? So instead of having to put up the money right now, because you don't know exactly what date, but you know that date is pretty soon, maybe your significant other has to ask time off from work. Instead, you lock in the price of the whole stay, 5 nights for $500 per night, guaranteed. The price cannot go up, and all you have to do is pay $50. So that's kind of how like an option works. I'm starting to get your mind to think about locking things in for a certain price. So now let's say the demand for that particular hotel goes up and the price for the same reservation is now $800 in just, 3 days from now. Because you've locked in the price for the reservation at $500, you actually have saved, right? You don't have to pay the extra $300. That reservation had a lot of value for you. You ended up saving $300 per night versus, having to pay $800 per night. You're good with $500. But now what if I told you that you made this reservation at 20 different hotels around the world and you weren't actually looking to stay at the hotel? Instead, you knew that the prices were going to rise and you ended up locking in $500 a night for 20 hotels, and then you're able to sell your reservation to someone else, and there's lots of demand. So everyone now, wanting to buy it for $800. So you can make $300 during that 5 days, so you can profit $1,500, and you've done that 20 times. That means that you paid $30,000, right? $1,500 profit, and then you've done it 20 times. You've just sold it instantly like that. That's kind of pretty much how options work. They let you lock in a certain price, but of course you have to pay for that. So the $30,000 is gross. And let's say you paid $50 for 20 rooms. Well, that's not a lot of money. That's $1,000. So you've turned $1,000 into $30,000. And that's kind of how options works. The only difference is that obviously there's no such thing as being able to resell a hotel reservation if the price goes up. But with an option, there are many contracts that you can buy and sell. And you can make a profit off of increasing supply and demand. So you can do it many, many times. As long as you understand what you're doing, then you can take calculated risk and you know the odds, the probability, which is what we're going to talk about. We're going to cover all of those details. You can make a lot of money. Now, there's 2 types of options. There's calls and puts. That's it. There's nothing more. There's no third option, just calls and puts, just 2. And here's the easiest way to remember the difference. A call option gives the buyer the right to buy a stock at a certain price. So if you buy a call option on Apple at say $220 per share and the stock goes up to $230, you can use that option to buy the stock for $220, even though the stock is worth more, and immediately sell at the current market price of $230. And boom, that's a $10 profit right there. And all you had to do was put up the reservation fee to lock in the $220 per share. So again, it's kind of like reserving a hotel room. You don't have to buy 100 shares of a company. An option lets you control 100 shares right away, which is really powerful stuff. So imagine you have to buy 100 shares of Apple for $220. Well, 100 shares times $220 is $22,000. And yeah, sure, like you can make $1,000 in say a week, but you have to put up $22,000. But instead, what if you only had to put up $500? And then when the stock goes up by $10, instead of making $1,000, well, you still make $1,000, but you only put up $500. So now you're turning $500 into $1,000 versus $22,000 into $23,000. The second way is much more attractive. A call option gives you that massive leverage. You make the same amount of money, $1,000, but you only use $500 instead of $22,000. The second way is much more attractive. A call option gives you that massive leverage. You make the same amount of money, $1,000, but you only use $500 instead of $22,000. In the option world, the reservation fee is actually called a premium. That's where the whole idea behind calls is. You buy them if you think the stock will go up, and you pay the reservation fee or the premium to get that right to have that call option and be able to participate in the upside if the stock ends up going up. your option goes up in value tremendously. A put option is the opposite. It gives the buyer the right to sell a stock at a certain price. So if I buy a put option on Apple at 220 and the stock price drops to 210, I can use that option to sell it at 220 even though it's worth now less. You buy a put option if you think the stock will go down. Now, that's the buying side, and I just wanted to give you a little bit of an intro to the buying side. And that's what most people learn when they first get started with options, and it helps you really understand, and it's basically the best way to start learning options. But that's not what we're actually doing here, because most people who buy options actually lose money. In fact, the statistics say that if you're an option buyer and you're buying out of the money options, you're going to basically lose more than 70% of the time. So the odds are really stacked against you. The clock is always running with options, and theta, which is one of the option main components, it's one of the Greeks of options. It basically makes the option worth less and less every single day. So if you're buying an option every single day, it's losing value. But if you're selling an option every single day, you're actually gaining value if everything stays the same, right? If the stock doesn't have any big jumps and it's just moving sideways, well, every single day there's something called theta, and theta is yours, and that's your income if you're an option seller. If you're an option buyer, you're paying theta, you're paying for something to happen in that specific time frame. That's why I don't really focus on buying options in my everyday trading. Now, buying options does have its place, and you can make a lot of money. But again, this course is focusing on retiring and creating consistent income. And for that, selling options is really where it's at. And here's where the real magic happens. When you sell options, you're doing the opposite of what most people are doing, which is guessing where the stock is going. And most of the time, the stock market is random. If anyone says they know exactly when a stock is going to go somewhere at that specific time and then make some bold claims, they're likely lying or trying to sell something or pretending, right? So we don't actually know what direction a stock will go. And there's a famous book called Random Walk on Wall Street. Okay, so nobody can really predict the market. However, if you're selling options and the stock market's random, but you sell options that are not that likely to happen, your chances of winning are pretty likely. So instead of betting on direction, you're getting paid to let others bet against you. And you're the house, just like you're in Vegas. And that house doesn't need to be any guesswork. They just need the rules and math to work out over the long period of time. One quick example is imagine flipping a quarter. It's 50-50, right? If you were to flip a quarter and you were going to win $1, you'd be willing to pay 50 cents for heads, or you'd be willing to pay 50 cents for tails. And basically, every time you flip, you wouldn't really be expected to make any money or lose any money, because on average, it's going to be 50% heads, and 50% of a dollar is 50 cents. So that's an even money play. Essentially, there's no profit there, okay? But what if I told you that you can now pay 45 cents for heads to win $1? You can also pay 45 cents to win if it's tails, and you also win $1. Well, every time you flip, it's going to be heads or tails, and the expectation is half the times heads, half the times tails, and you're going to win 50 cents each flip, right? On average. If you're paying 45 cents to win 50 cents, sure, it's not a lot of money, right? But if you do that many, many, many times, then that adds up. You're basically picking up a pretty big sum of money over many trades. For example, if you've done it like 10,000 times and you put up $4,500, well, you end up winning $5,000 on average. So this is the concept that I'm going to teach you in the strategies. So what happens when you sell an option? You're agreeing to take the other side of someone else's bet. If you sell a put option, you're saying, if this stock drops below a certain price, I'll buy it from you. And you get paid up front for making that promise. If the stock doesn't drop, you keep the money and nothing happens. If it does drop, you buy the stock at the price that you already decided that you were comfortable with at the terms of when you opened it. That's called a cash secured put, and it's one of the best bread and butter strategies that I have. If you sell a call option, it's the same idea, but it's flipped. You're saying if the stock rises above a certain price, I'll sell it to you. And again, you get paid upfront for making that promise. If the stock stays below that price, you keep the money. And if it goes above it, well, you have to sell the stock and walk away with a profit. That's called a covered call, and it's the other half of our system. So today, the system and process that I'm going to teach you is going to be selling puts, picking a strike price, selling covered calls once assigned, picking a strike price, and this system and process we'll talk about will be called the wheel strategy. Now, the beauty of selling options is that you don't need the stock to moon, you don't need the stock to crash, you're just relaxing. You're just picking a strike price you're happy with. If it happens and you get assigned, good. If you don't get assigned, you're still good. You're actually making money when the stock doesn't really move that much, but if it does move a lot, that's fine as well. You're still going to make money. So even if the stock goes against you a little bit, it's not a problem. You're stacking the odds in your favor, collecting premiums, and you're in control of the risk from the very start. And in fact, with this strategy of selling options, it's safer than stocks. Hands down, it's a lot safer. I'm going to show you examples later on in this video. Here's the best part. You're getting paid for being reasonable. You're not hoping for a lottery ticket. You're saying, I'll buy the stock if it gets cheaper, or I'll sell it if it gets more expensive. And someone else out there is willing to pay you for that position. It's a huge win-win because someone else out there is either hedging their portfolio or it's a huge pension fund that has to buy options because they need to protect themselves, and that's part of their mandate. And you're just taking advantage of that as a retail trader like myself. You can also collect income from these big institutions that are trying to protect themselves. So you're either collecting income and keeping the stock, or you're getting paid while waiting for the stock to basically go down and buy it for a discount. It's really a no-brainer, and it's almost like too good to be true. It's like a chicken egg. Chicken eggs are super cheap to produce, super nutritious, healthy, right? It's pretty wild how good of a deal you get with a chicken egg. And it's the same thing with the strategy. It's pretty wild how good the strategy really is. People think option selling is risky, but most risks come from not knowing what you're doing. If I sell a put far below the current price, I'm saying I'll buy the stock only if it crashes 15% or more. And for taking that risk, I get paid today. And the market goes, wow, thank you for your bravery. Here's a pile of cash right now. Like, what? What's the risk? Getting paid not to buy a stock unless it's on clearance? Man, that's not even risky. That's like Black Friday shopping with a coupon. To really understand why this works, you need to know about something called time decay. Every option contract has an expiration date, and the closer it gets to that date, the less the option is worth. That's because options are constantly losing value due to time decay, and also known as theta decay. Every single day that goes by, an option is worth a little bit less and a little bit less until basically zero at its expiration if it's out of the money. Now, who benefits from this time decay? And you might be surprised, but it's the seller, because when we sell an option, we collect a premium. And as time passes, that option loses value. Most of the time, it expires worthless, and you get to keep the full amount that we collect. We mentioned that most option buyers are losing about 70% of the time, while most option sellers are winning 70% of the time. It's exactly reverse. It's an exact flip, and that is the most amazing secret that you can take advantage of. Now, I personally sell options the same way insurance companies sell insurance policies. Most of the time, nothing bad happens, and I get to keep the premium. But unlike insurance companies, I don't need a fancy office. I don't need to have like a green gecko running around. I don't really have to have a math degree to simply sell premiums, profit, and repeat it every single time that options expire. Now, if they do expire in the money, I'm also okay with that because we'll talk about a little bit later in this free course, selecting the right stocks and selecting the right strike prices. So even if it doesn't go according to plan, it's completely okay. Now let's put this into perspective in the real world example. Imagine you own a rental property. You bought a house, and instead of letting it sit there, you rent it out to tenants. Every month they pay you rent. And as long as they don't destroy the place, hopefully, fingers crossed, hopefully they don't destroy it, you're making money, right? And if you pick a good neighborhood, you're gonna make consistent income because these tenants are going to pay the bills. The value of the house itself doesn't really matter in the short term because you're generating cash flow, and you know that eventually housing prices always go up. So maybe in 1 month the house goes a little bit down, maybe a little bit up. It doesn't really matter to you. You're looking at the cash flow aspect of the house that's generating you rent income. Selling options is the same exact concept. Instead of renting out a house, we're renting out the right to buy or sell a stock. And that's just like a landlord collecting checks and rent every single month. We collect option premium every single month. But here's where it gets even better. If you own a rental property, you have to worry about things like maintenance, property taxes, bad tenants. Again, you hope that you don't get bad tenants. That's the worst as a rental landlord. And I know because I work with a lot of people, especially in the real estate industry. So the good news is with options, you don't have to deal with any of that stuff. No fixing leaky pipes, no chasing down rent payments, no having to contact people or like leaky roof or anything like that. You're just selling contract and you're collecting cash as long as you pick the right stocks, you pick the right strike prices, and Time's a really huge component. Doesn't happen overnight. Each option, it takes time for it to go to expiration where you collect your money and actually get to keep the money. You see, when you open up an option position, the cash will enter your account right away, but you still need the option to expire for it to leave your account. Otherwise, it's still in your account, of course, so it can still go against you, and it's important to properly manage that position. Now, before we start selling options, we need to go over two very important, variables that determine how much money we're going to make. Implied volatility and probability. Okay, these two things are not really talked about that much on YouTube, but they're incredibly important. Let's start off with implied volatility, or IV. This is a measure of how much a stock is expected to move in the future. You will see something like the VIX. The VIX is the fear index on Wall Street. That's what people refer to it. But really, the VIX is just telling you what the implied volatility will be in the market for the next 30 days. You can Google right now, go to Yahoo Finance and go to VIX. But long story short, volatility or implied volatility is how much investors in the stock market expect a stock to move up and down and how volatile they expect it to be over the next 30 days. The higher the implied volatility, the higher the option premium. And that makes a lot of sense because if you're selling options, the option can go against you. Again, going against you sounds bad, but going against you can be okay if you want to own the stock in the case of selling a put option. However, it doesn't really matter because many people are trading options without taking assignment at all. And we can talk about that later on. What I need you to understand is that higher implied volatility equals higher premium. That is always the case because higher volatility is a substitute for basically higher risk. And when there's more risk, people want to get compensated more for that risk. That's why dangerous jobs, those that go fishing in Antarctica on boats for a very long time, they get paid a lot of money because there's more risk to that job. Jobs with more risk usually pay higher. And this is a natural law within finance. The more risk you take, the more return you should expect. That means we can collect more money with selling options when implied volatility is higher. So specifically, when the market has a lot of turmoil or lots of volatility and stocks are just going up and down, although it's uncomfortable, it's actually a great opportunity to sell options and specifically to buy stocks for a cheaper price. And I always buy stocks through options. I'm usually not just buying stocks, I'm usually buying stocks for a discount using the option strategies that we're going to talk about. And this is also why it's really important not to sell options on random stocks, okay? We're not just looking for random stocks. We're looking to focus on stable, well-known companies that don't really have wild price swings, that have good products, good services, good brand, not too much debt, good balance sheets. So I'm looking for many different factors that make a company a good long-term bet. This is why stocks that have a big brand, lots of innovation, Tesla, Nvidia, Amazon, they tend to have really good premiums. They still have volatility because they're in the tech space, and tech companies are naturally a bit higher on the volatility because tech and technology has more change and there's more disruption. If you can think about a company like Tesla is going to have more risk than Coca-Cola. So when we go over an example later on comparing volatilities, well, this is why trading stock like Tesla, Nvidia, Amazon, or any tech company is going to be worth a lot more in premium versus something like Coca-Cola and Pepsi. You can't really disrupt Coca-Cola and Pepsi. They have basically a monopoly. Everyone drinks Coca-Cola, lots of athletes, everyday people in many countries are even addicted to soda, right? And there's not a whole lot of innovation. Soda is soda. We're going to drink it. But with something like Tesla, there's a lot of innovation, there's a lot of change, there's a lot of disruption. For example, Tesla sells vehicles in China, and China has their own homegrown companies, NIO, BYD, and there's a lot of competition, right? Whereas Coca-Cola doesn't have much competition. So investors naturally know, and they place a higher implied volatility on riskier stocks, and Tesla is absolutely a lot riskier than Coca-Cola. Now, probability is where things get really interesting. Every option has something called a delta, which is a rough estimate of how likely that option is to end up in the money by expiration. And if you don't know what in the money means, it's just another option trading term, which basically means if a stock has gone past the strike price at which you're trading that specific option. So let's say that you've sold a put option for $100. And if that stock goes below 100, it's now in the money because it's below your strike price and it's below the price that you set. So in the money is when the stock would be below the strike price when you sold a put option or above the strike price when you sold a covered call option. Anyways, back to talking about delta. So if an option has a delta of 0.3, that actually means that there's a 30% chance that the option will expire in the money. That's what delta means. It's the chances that the option will expire in the money. It's those exact chances. So for example, if the strike price is exactly the same as the stock, so say we have a $100 stock and the strike price is 100 for a call option or a put option, that delta is basically going to be really close to 50. And that's because there's about a 50-50 chance if you're right there at the money that it'll either go up or down. If a stock like say Palantir is trading at $88 per share, which is roughly where it's trading at when I'm making this video, if you sell a $60 put, that's really far away from the current value of the stock, right? So that delta is going to be really low. Maybe something like 8 delta, 0.08. There's only an 8% chance that can happen. You can really quickly see how you can potentially take advantage of low probability things, of things that are not likely to happen. And the key here is that the lower the delta is, the higher the probability that an option will expire worthless. But here's where a lot of people go wrong. When they sell options, they actually get greedy. So they start, first of all, selling really low delta, and they get successful because, of course, you're going to be successful when you're selling very low delta. So they get a little bit higher delta, a little bit higher, and they start making more money and more money until there's like a market pullback and you end up losing a lot of money. And that's like a big mistake. People get greedy. They start going for really high deltas. You don't want to do that. You just want to stick to one formula. For me, my sweet spot is a 30 delta. All the time when I'm in my Discord sessions, when I'm trading live, I do that Mondays and Wednesdays in my group community, I'm usually doing 30 delta. So a lot of the times I say we don't need to recreate the wheel. We don't need to do anything crazy. We don't need to go for high delta, but we also shouldn't be going for really low delta. Really low deltas like 10 delta will win. You'll get income, but you just won't be making that much money in the long term. And your return will be okay. Your risk will be really low, but you're probably not even going to outperform the market. If you're doing 10 deltas, you're probably not going to match the S&P 500. So the goal is to make a lot of money, as fast as possible, as safe as possible. So we're really going to be controlling for many different variables here. Now, again, what we want to do is sell options that have a high probability of expiring worthless, usually around 70 to 80%, which means the delta that we're going to choose is going to be between 20 to 30%. This way, we're stacking the odds in our favor. Think about it like this. If you go into a casino, every single game, whether it's blackjack, roulette, craps, whatever, is designed so the house has a statistical edge. It might only be a small edge, but over thousands of bets, the edge guarantees that the house does make money.
What is the worst casino game in terms of odds? There's no question the worst game in a casino are the slot machines. Odds range of anywhere between 80% to 99% payout. That means when you put $100 in, you may only get $80 out or $99 out. Most of the casinos don't kick you out for winning because they believe the law of large number will eventually help the casino win back any money that you've won in the short period of time. This is the concept that in statistics, no matter how random something is, when you do a lot of these random events together, at some point, there is a norm that comes out. That's called the law of large number.
When we sell options, we're doing the exact same thing. We're making sure that the math is on our side. We're selling contracts that have a high probability of expiring worthless. And because time decay is working in our favor, even if we're slightly wrong on direction, we can still win. This is why selling options is the closest thing to passive income in the stock market. Once you understand the probabilities, you can set up your trades and pay yourself every single month with a high chance of success. Now let's talk about the first strategy, selling cash secured puts. This is one of the easiest, safest ways to generate passive income, and it's perfect for beginners because it works even if you're brand new to options. Cash secured puts are one of the most important strategies in this system, and today we're going to break down so that you can use them with confidence. This is the first building block of generating passive income from options, and once you fully understand how it works, you're going to start to see why it's such a powerful tool. At its core, selling a cash secured put is a way to potentially buy a stock at a discount while getting paid for it. Instead of simply waiting for a stock to drop in price and that you're comfortable with, you can sell a put option at the strike price that you're comfortable with right now, like right this second. And you get to pick that strike price, and you also get paid a premium. If the stock stays above that price, all good. You don't have to buy anything, and that premium is yours. If it goes lower, it's still a win-win scenario, because if it goes lower, now you have to buy the stock at that price. But if you don't mind buying that stock at that price and you want to buy that stock at that price, well, you basically just got paid to buy something that you wanted to buy anyways. And the reason why it's called a cash secured put is that you need to have enough cash in your account to cover the purchase in case you're assigned the shares. So for example, if you sell a put with a strike price of 100, you do need to have $10,000 available to purchase 100 shares at that price. If you have a smaller account, then this is basically where the credit spread strategy that I'm going to talk about later comes into play. Or you can sell put options on cheaper stocks like $20 per share, $10 per share, even cheaper than that. I mean, if you look at a stock like SoFi, you can sell a $10 put and that'll only be $1,000 instead of $10,000. This way, if you only have $1,000 of collateral per contract, that's fine. And of course, you do need to have proper risk management and not have too much in one single position, because that can be dangerous. So if you have a small account, then you want to put in stocks that are cheaper so you can have smaller positions. Let's go through a real example. Imagine you're interested in buying NVIDIA, which is currently trading for $110 per share. You like the stock, but you'd rather buy it for a lower price, say $100. Instead of waiting and hoping that the price drops, you sell a put option with a $100 strike price. For this, you receive a premium of, let's say, $3 per share. Since each option contract represents 100 shares, that means that you immediately collect $300 just for agreeing to buy NVIDIA at $100 if it falls to $100. So you get paid $300 to get a chance to buy NVIDIA for 100. If it doesn't go there, 300 is yours. If it does go there, you have to buy NVIDIA and 300 is still yours. So, it's like amazing. Now, there are two possible outcomes. Again, if NVIDIA stays above 100, the option expires worthless and you keep the $300 worth of premium. You don't have to buy the shares and you don't have to do anything. The option is out of your portfolio that Friday of expiration, whatever expiration day is. And then Monday, you're basically able to do it all over again if you want, or reinvest that capital into something else, or just go have fun with the money, spend it for whatever you want. Now, if NVIDIA drops below 100, you will be required to buy 100 shares at 100 per share. However, because you collected $3 per share in premium, your actual cost is actually going to be reduced to 97 per share. That means you're getting a further discount compared to the strike price that you selected, because the true break even is the strike price minus the premium. So the strike price is 100, the premium is $3 per contract, then your actual price is going to be 97. So the key takeaway here is that selling cash secured puts, you are in control. You are the man or the woman. So you're not blindly buying stocks at any market price. You're choosing, you're getting to select when you want to buy it, when you want to, and you get paid for that. So instead, you're choosing your entry strategically and you're getting paid for your patience. This strategy works best with stocks that you actually want to own. This is the most important part. If you're trading this on stocks that are just garbage, some YouTuber talked about it, some rumors here and there, that's not a good strategy for success. So there's an important point here. Don't sell puts on stocks you wouldn't be comfortable holding long term. If you're only selling puts because the premium looks attractive, but you don't really have any interest in owning the stock, don't do it. You're taking unnecessary risk. And oftentimes what I see happening is people will do it on stocks that I personally don't like. I've been saying MSCR, SMCI. When they were high, I was completely not about them. A lot of people were saying there's a lot of money to be made here selling puts. Well, and it ended up happening that you lost a lot of money. So only do it on stocks that you can see yourself owning for, let's say, a year or more. One mistake that beginners make is choosing the strike prices that are just too aggressive. So for example, let's say the stock is trading for 110 like NVIDIA, and you sell a put option for 108. I mean, it's still better than nothing because it's still $2 below the price. So, instead of buying the stock for 110, you're buying it for 108 and you're getting paid, but still the chances of getting assigned are very high. And unless you really, really want to hold the stock this week, then you're just going a little bit too high in the delta. If you lower the delta, you can collect premium 3, 4, 5, 6 times in a row before you even get assigned. Because remember, again, if you sell at a 30 delta, well, a 30 delta means that you're only going to get assigned 3 out of 10 times. A more conservative approach would be to choose a strike price which is way further out of the money. In fact, you can go much lower. You can go for a 95 strike price. So if NVIDIA's at 110, you can go out 1 month, 95 strike price, or even 90. And then if NVIDIA goes to 95 or 90, I mean, it's a steal. Like, you're literally you're pretty much robbing the other person. You're getting such a good, fantastic deal. And we've actually seen that. There has been, volatility in 2025. And when a stock pulls down, that is essentially a really good opportunity, because oftentimes stocks do recover and they bounce. So when you sell a put option, don't be concerned if it goes into the money. First of all, again, you want to own that stock. And second of all, if there's still time, it may bounce out of the money. So sometimes it's even frustrating because the strategy is so good that a stock will go into the money. You're excited. You're like, I get to buy a stock for cheap. And then it bounces back out of the money. And because it bounces out of the money, you don't actually get assigned the shares. So keep that in mind. The strategy is so good that you might not really get assigned for a very long time, and you might collect a lot of passive income for a very long time without actually owning any shares, which is also very good. Another mistake, and this goes back to implied volatility. Higher volatility means higher premium, but also means bigger price swings. So if you can't really handle big price swings, then don't go for high implied volatility. It's a double-edged sword. High implied volatility is very good because it's high premium, but also high volatility is there for a reason. It probably means that the stock has really wild price swings. So if you sell a put option on a stock with extremely high volatility, you might collect a big premium, but the risk of the stock dropping significantly also is increased. The goal here is to find a balance, stocks with reasonable volatility that offer solid premiums without excessive risk. So how do you pick the best stocks for cash secured puts? The ideal candidate are companies that are fundamentally strong, meaning they have solid financials, steady revenue, growing revenue through history, and a history of just general stability. The company does not have wild swings. It doesn't miss earnings. The CEO has been at the company for a long time. They have good management. And generally, that's the type of company that you want. You don't want to sell puts on speculative stocks that could crash overnight. Say Bitcoin crashes, and then all of a sudden you get these mining companies that also crash. I mean, I like to go for something that has consistent and good cash flow. A company that's growing their cash flow year after year. And that could be an example like Starbucks. Starbucks does have volatility, but generally speaking, Starbucks has been a phenomenal investment, and they're still expanding stores in, say, China. Focus on well-established companies that you're comfortable owning in the long haul and that you can actually make a story around, a story that makes sense to you, a story that actually contributes to growth of the company. Let's say you've successfully sold a put and now you want to make this a consistent income stream. How often should you sell cash secured puts? The most common strategy is selling them on a monthly basis, choosing options that expire within 30 to 45 days. This time frame strikes a balance between earning a decent premium and reducing the risk of short-term market fluctuations. But what happens if the stock starts dropping towards your strike price before expiration? This is where having an exit plan is crucial. Your exit plan can be very simple though. So for example, if the stock ends up falling a lot, then you might decide that you don't like that stock anymore. You can actually either close that trade anytime. Specifically, if it hits into the money very early and very fast, you might decide, I don't want this stock. You can close it. You can also roll that position. We'll talk about rolling towards the end of this course because rolling is a more advanced strategy. But this only happens maybe 10, 20% of the time. So if there's a 30 delta, you're going to get assigned 30% of the time. Basically, a majority of that time, things are going to go really smooth. The stock might pull down, might hit your strike price, but not by much, and there's very little time left. So you're cool, no worries. Basically, you're just getting assigned the stock. That's probably like 25% of the time or so. Now, the other chunk of that, basically there's 30 delta, 25 out of 30 times, things are good. 5 out of 30 times, it'll basically be, it'll fall a lot, and then you have a choice to make. And we'll talk about that choice a little bit later on. But I want to point out that managing this strategy is pretty easy. So although it's crucial to have an exit plan, the exit plan is really only if the stock is completely changed fundamentally. something really big happens, like management has changed, they miss earnings by a lot, and you no longer like the stock. That's pretty rare. It's probably about 5 out of 100 times. So basically, the numbers aren't super important. What I'm trying to get at it is very low likelihood of having an issue. But if it does happen, we'll talk about rolling and closing the trade out. So if the stock is getting close to the strike price, you don't really want to get a sign. You can buy back the option. Now, this will likely result in a loss because if you buy back an option that has now increased the chances of getting a sign, then it's now much closer to that strike price, it's going to be worth more money because the risk has increased and the risk has changed. So now it's going to be worth more than what you've sold it. And because it's worth more to buy back, it's going to cost you money. This is why I don't really recommend buying back the option. And like almost all the time, it's super rare that I just buy it back, only in like a market crash where I just really don't like the stock and I really change my opinion. That's very rare. Most of the time, just take an assignment and I'm happy to own the stock. But it is good that you do have the flexibility that you can buy back that option anytime that you wish, including for a profit. So if you sell an option for $300 and it's made $250 in just a week and that option has 1 month to expiration, well, if you're happy in 1 week to make $250, then that's fine. That, on a contract basis, you can just close it out. Now, if you have 10 contracts, even better, right? You just close it out, $2,500 in a single week. So you have a lot of flexibility and you are in full control to close out this option trade whenever that you wish. Now, you might be wondering, what's a long-term benefit of selling cash secured puts? The real magic happens when you reinvest your premiums. Instead of just pocketing the cash, you can use that income to sell even more puts, buy more stocks, or even use this money for different strategies. This creates a compounding effect and it steadily grows your account over time. Another great aspect of the strategy is that it works in different market conditions. If the market is stable, you continue to collect premium every single month. All right, now let's talk about risk management. Risk management is super important. Just because cash secured puts are a conservative strategy doesn't mean that they're without risk. The biggest risk is if the stock does drop significantly below your strike price. If Nvidia, in our example, fell from 110 to 80, you'd still be forced to buy it for 100 if that is the strike that you sold. So even though it's now worth a lot less, you still have to buy it for 100. And that's why choosing the right strike price is very important. We cannot predict stock market crashes, so sometimes when they do happen, usually it's still fine. It's just a waiting game because you're cash secured. That's why it's called a cash secured put. You want to avoid stocks with extreme volatility that could take a huge dive. Of course, there's a little bit of a trade-off because stocks with higher implied volatility have higher premiums, and selling higher premiums means that you'll have a higher income and it's much easier to retire with the high income. This is why you need diversity, and I recommend having 10 to 15 stocks in your portfolio. Now, I also recommend to have, mainly 15 to 30 positions that are option positions. Now, 30 is a little bit high, but it also includes smaller positions that are kind of more fun. You can truly just get away with having 10 option positions and then you're good. You can keep it really, really simple. So to sum it up, cash secured puts allow you to generate income while waiting to buy stocks at a discount. You collect premium, whether or not that you end up getting assigned or having to buy the shares. And if done consistently, this strategy can create a steady stream of income into retirement, and truly you'll be surprised. I've seen some of my students that have 300K, 400K, they're making, 3 to 5% per month, especially when there's a bull market, and 5% of 300K, $15,000 is a lot of money to have as just free cash flow that you can spend and do anything that you want with. Next, let's talk about liquidity, because this is another key factor. Liquidity refers to how easily you can buy or sell the stock, and more importantly, for options, how active the option market is for that stock. When you choose a stock with a high liquidity, it means that there's a lot of other people trading that option contract on that stock, which makes it a lot easier to enter and exit that position at fair prices. This is very critical because you don't want to be stuck with an option that you can't close out without a significant slippage. Stocks with high liquidity generally include those that are widely held and traded by institutional investors. They tend to have a robust option market with narrow bid and ask spreads. This helps ensure that the premium that you collect is a good reflection of the market, and it minimizes your risk when you need to make adjustments to your trade. So when you're looking to roll a position, you want the bid-ask spread to be tight. Let me show you an example of a good bid-ask spread and a bad bid-ask spread. All right, so let's analyze some bid and ask spreads. I'm going to go to Apple stock right now. I'm going to show you an example of a stock that has a lot of volume and what the bid-ask spread looks like. So I do have a lot of Apple shares. I'm going to go to trade Apple options, and I'm going to show you an example of selling a put option, and then we're also going to go over an example of a covered call. So going into selling a put option, you will see if I go down to a nice even strike of 200, the bid-ask spread here is pretty decent at 9 cents difference. Lots of volume. That's really important whenever you're trading options. You want to look for lots of volume. Open interest is pretty high, but here what stands out is because this option actually expires today, June 6th, as I'm making this, there's just a lot of volume traded, which is expiring on the same day. That's just a common trend in the market. People like short-term options nowadays. If I go to the 195 strike here, it's actually the best bid-ask spread ever. It's a $1 difference, 17.18. You can see here though, the volume is a little bit less than the open interest. Now both of these options are pretty good because anything less than $10 in terms of the bid-ask spread is good enough, really. So here it's a $1 difference. On the 200 it was $9 difference. If we start going down here, okay, 185, the chances of this happening are super low, but also doesn't make sense for you to trade this at all. It makes 0 sense. Since the bid is 2 cents, the ask is 3, you're like losing $1, and that's like a huge portion of this entire premium that you're collecting. So it doesn't really make sense to do super short-term options, and it's not really a viable retirement strategy anyways. Instead, what you want to do is let's go out about 30 days into July. So now you will see that if I expand the 200, the bid-ask spread is actually very wide. Now I am recording this pre-market, so it's likely to change, and typically Apple has a very tight bid-ask spread. Let's also just go down a little bit down to the 195, and pretty much same story here. It's a very wide bid-ask spread, and that's likely because this is pre-market. But let's go to sell call, and I want to show you what selling calls also looks like. So 210 strike, and here it's about the same bid-ask spread. Okay, so this is Apple. Typically, it is going to trade very, very tight. Okay, so you understand how cash secured puts work. You know that they're going to be an agreement for you buying or selling a stock at a certain price, and you're getting paid up front for making that promise. But now the question is, how do you choose the right price to make that promise at? And how long should that promise last? And that's what this part is all about. We're going to talk about strike prices and expiration dates in a way that actually makes sense. No complicated charts, no technical formulas, just clear real life thinking. So let's start with strike price. Think of the strike price as the price tag that you're putting on the stock that you might end up buying. If a stock is trading at 220 and you sell a put at 210 strike price, then what you're really saying is I'd be willing to buy this stock if it drops to 210, and that's it. You're basically naming your ideal entry point. You're naming the price at which you would buy. And that's like putting in a limit order, except that you're getting paid to basically enter a limit order. Now, here's the important part. You got to be totally cool with owning the stock, because if the stock falls down, well, you get assigned. You already know that. So what's a good way to figure out if it's a smart strike price? Well, start by thinking in simple percentages. If the stock is at 210 and you can get paid $22, well, that's a 10% return. And if you end up selling an option for, say, 200 strike price and the stock's at 220, well, that's pretty good, right? Because you get a 10% return and the stock has to fall 10%. And then you're still gonna have a lot of like basically leeway room. So your break even, if you get paid $20, you sell 200 strike price is 180. And if the stock's at 220, you have such a huge amount of room. Now let's talk about expiration date. This is one of the other half of the trade that's super important. If you've chosen a strike price, cool, but what expiration date do we choose? And essentially for me, it's 30 to 45 days. And that's the sweet spot for me. If you go really short term, the issue is, yes, it's good. You get a lot of income really fast, but there's a lot to do. There's lots to manage. You have to pay attention. And for me, I don't want a full-time job, nor do I think you want a full-time job. So 30 to 45 days really falls into that category of passive income. And as you know by the title, this video is all about retiring with selling options. So we're looking to retire. We're not looking to create a second job for ourselves. So for me, shorter term expiration dates are okay if you're like learning and you really want to get your feet wet. You want to have a lot of reps under your belt. But the ideal situation is that you're just selling options that are 30 to 45 days. In fact, lots of my students and the folks that I work with that are into retirement, they're either even going for like 60 days, 75 days, or even 90 days to expiration. You collect a lot of premium up front when you sell an option that's like 90 days out, because there's obviously a lot of time. So there's a little bit more risk. There's a little bit more risk over a 90-day period, of course, than a 30-day period. And there's more risk over a 30-day period. More can essentially happen versus like a 7-day period. So here's a helpful way basically to think about this whole setup. Imagine you're a landlord renting out a house, and the strike price is the price that you're willing to buy the house for if the tenant ever decides to basically sell it to you. So let's talk about how to actually pick the strike price and expiration date when you're setting up a trade. Here's a few little like tools and little bit secrets and keeping it really simple. So let's break this down. So say SoFi is trading for $12 per share and you really like the company and you would love to own it, but only if it were to get down to $11 or lower. Well, basically check the option chain, and if the 11 strike price, say it's like 35 days out, 40 days out, as long as the delta is around 0.3, the expiration date actually doesn't matter that much. So you can go for a 7-day expiration, 30 delta or roughly 30 delta will be perfectly fine. If it's 28 delta, don't worry about it, 33 delta, that's fine. You just want to be generally in that vicinity because that's really the sweet spot. Again, you're getting a mixture of good income and balanced risk. So for me, if a stock is say 12, selling 11 is perfect. I mean, there's not a perfect solution where selling $11.45 is perfect. No, just go a little bit lower, pick around 30 delta, super simple. And that's a good way to basically get potentially assigned into the stock that you want to own and get paid for it. It's as simple as that. Now, here's a little trick that a lot of experienced traders use. Look at support levels of the stock chart. See if the stock has had any hard bounces. And essentially, that's a support line. So there's something called a double bottom. So if a stock bounces hard from a certain level 2 times, well, that's a double bottom pattern. So don't worry. This is very basic technical analysis. All you really need to know is see where the stock has gone, like the lowest it's been. That's like one good indicator of there's good support at that level. You can also use RSI. If the RSI is pretty low, that just means that the stock is sold off. And if the stock is below its 60-day moving average, that also means that it's just a little bit cheaper than average. So, it's like going to your favorite store and let's say a t-shirt's $30 and you go there and all of a sudden you see that t-shirt's $27. Well, that's below average. I mean, on average it's 30, now it's 27. So that's a better deal. Now, of course, this doesn't guarantee anything, but it adds up. When you look at like lower RSI, when you look at the chart and you find support, and if you sell out of the money options, a combination of these things will make you really successful without having to be lucky, without having to be a genius, without really having to like guess. So without getting lucky, you actually collect income consistently on high quality companies by selling put options. Now in the next section, what I'm going to do is I'm going to talk about what happens after you've placed a trade, what happens when expiration hits, what to do if you get assigned, what to do if the trade isn't going perfectly. And this is where kind of the rubber hits the road and you have different options and different things that you can do. So hopefully that you've understand all of selling puts, what strike prices, what expiration dates. We're now going to move over into the next section, which is managing and rolling cash secured puts. Let's say that you've sold a cash secured put. You picked a stock that you should be happy owning. You picked a strike price that you're happy and makes sense for you. And now you have a nice premium you're happy with, but it goes down and it's under your strike price. What do you do now? Well, this is exactly the section that's going to talk about managing this trade and what you can do if it goes into the money. Because here's the truth, selling a cash secured put is a high probability strategy, but it's not perfect. There is no strategy that's perfect. If anyone tells you there's a perfect strategy, they are BSing you and they are completely... I wanted to come up with something funny. I can't think of anything funny right now, but you get the point, right? Not every trade is going to expire worthless. That's obvious. And that's completely okay because your job isn't to avoid losses at all costs. Your job is to manage trades with confidence, protect your capital, and keep your income system running smoothly so you can retire and have passive income. So the first thing that you need to do is basically once you lock in a trade, think to yourself, am I happy owning it at that price? And the answer almost all the time is yes. And you have the flexibility to actually adjust that slightly. It's called rolling. Rolling an option is basically where you can change the strike price. You can change the strike price and the expiration date. Rolling a cash secured put means that you're closing your current position and opening a new one just like you saw me do. You're rolling the trade out in time and rolling it down in price. By rolling it out and down, you're reducing your risk and you're putting more time on it, so it has more time to recover. This is how you stay in control. You're not panicking, you're taking a loss and walking away, or in the example that I showed you, you're taking a credit. You're actually getting paid, so it's actually a good thing. Now let's draw another example just so you can see the example and now you can visualize it even better. Suppose you sold a 210 put on Apple, which was trading at $220 per share when you entered the trade. Now Apple is trading for $209 and the expiration is 3 days away. Your put is in the money. You could let it ride and hope for a bounce, or you could roll it out a few weeks and down to the 205 strike price, collecting a $2 premium in the process. You've just bought yourself more time, my friend. Also, you've lowered your break-even price. Now tell me, how does it get better than that? Like seriously, going down in strike price and getting paid for it, getting paid to reduce your risk. Amazing. Now, rolling isn't always the answer though. Sometimes getting assigned is completely okay. I'm just giving you strategies to basically manage your position in the best way that you want to manage. There isn't a perfect example or a perfect answer. For me, most of the time, I just get assigned. Sometimes I roll. Those sometimes happen essentially either I might be trading on margin, which I'm not going to discuss margin in this like beginner course. Margin is really for my one-on-one clients that I work with, and I help them scale because some folks I work with have 6 figures and they want to scale to 7 figures, and I do one-on-one coaching. So that is the first link in the description that you can check out if you are interested and you have a bigger portfolio. But if you're more beginner, which this course is really for more beginners, don't worry about margin. But for me, the times I don't want to get assigned is because I don't really have the cash, or I have found the better opportunity. And that happens sometimes as well. I see a stock that has sold off and I'm like, well, I want to shift some of my capital into that new opportunity. So managing cash secured puts successfully means being flexible, staying disciplined, and really not letting your emotions drive you, and just realizing that most of the time it's completely okay to get assigned. And when you don't want to get assigned right now, you can roll it just like the same example that you saw. Over the course of many trades, even if a few don't go perfectly, your overall income is going to grow. And because your risk is defined and your capital is backed by cash, you're never really overexposed. This is what a cash secured put is so powerful, because good income, very low risk. You buy stocks, you get paid to buy the stocks. And as soon as you do get assigned, you actually have other tools at your disposal to make even more money. So that's why getting assigned only begins the next step of the strategy. Now that you have seen part of this income machine, this income formula, this system, this process, let's say that you've gotten assigned. Let's talk about next steps. Let's get into the next section. This next section is covered calls and how to create income from stocks that you already have. Or if you've gotten assigned by selling a put option, you have stock, well, you can still create income. Let's go over that. Let's say that you already own shares of a stock that you really like. Maybe you picked it up from a cash secured put that you got assigned from, or maybe you've just been holding it for years. Either way, it's just sitting in your account doing nothing. Well, you should be creating income on every single position that you have that has 100 shares. You should be selling covered calls. Covered calls basically take shares that you already own, they turn them into income producing assets. Okay. Even if they pay dividends, that's fine. You can now create another dividend, a huge dividend, by selling a covered call. And at its core, a covered call is very simple. You're agreeing to sell your shares at a specific price, the strike price, by a specific date. In exchange for making this agreement, essentially someone else pays you an upfront premium, right? So again, it goes back to the beginning of this course where it's like the hotel room, someone wants to lock in, or you want to lock in that hotel room for $500 a night, and you're scared that it's going to increase. Well, that's the same example here. When you sell a covered call, you are actually selling someone else the right to buy your shares from you at that price. So for example, let's say that you have a stock you just bought in today into NVIDIA for $110 per share, okay? And you're happy at 110, or you got assigned at 110. Either way, you are okay selling it at 120. Well, instead of saying I'm okay selling it at 120, we'll see what happens. Why not get paid today, right now, to sell a covered call at 120? So check it out. If you sell a 120 covered call and you end up selling this covered call 30 days out for 120 and you get paid $5, that's amazing. That's awesome. Because look, here's what can potentially happen. Here's the scenarios. Scenario one, nothing happens, NVIDIA stands still, and you've collected $5 of premium. So that's good. Like, you've made money. Now, let's say that NVIDIA slightly goes up from like 110 to like 115, 117.45, 118.92. It doesn't matter. As long as it goes up but under 120, well, you actually made money on the stock and you still got the $5 worth of premium that you've collected. So now you have like best of both worlds. You're making money on the stock, appreciating in value. You're making money on the premium. That's amazing. You have like 2 sources of income essentially. Now, I will tell you, if it goes above 120, that's no longer yours. Like, bye-bye, it's not yours. And, that might be disappointing until you realize, like, going from 110 to 120 is like almost, let's call it a 9% return. It's not quite 10%, but it's like a 9% return. And if you got paid $5, like that's another 4.5% return. All of a sudden you made 14%. And if that's in 1 month period, because NVIDIA has higher implied volatility, that's a lot of money, 14% in 1 month. So if it rises above the strike price, your shares, they will get called away and you will have to sell them, but at the strike that you agreed on. So you agreed on 120, then bye-bye at 120, you get rid of them. Of course, there's some like tax consequences there, but hey, you make money, you pay taxes. I just want you to be aware, not a tax advisor, and I usually don't talk about taxes, but I want you to be aware that, you're making money. You'd have to pay taxes, and this situation would be amazing, going from 110 to 120, plus you have the $5 worth of capital. Now, there's another scenario. Other scenario is NVIDIA crashes. It's a scam, which is not the case. We never know in this life, so probably not the case. Most likely, very, very small chance. But I'm just trying to paint an example of NVIDIA goes down a lot. It goes down to $60, $70, right? You're going to lose money. You're going to lose money just like anyone in the world lost money. When the stock market crashes, everyone loses money. So when a stock crashes and you're using this strategy, you're going to be down. But keep in mind, you're able to close out the covered call anytime, and the covered call actually still helps you a lot, because had you had just the stock and NVIDIA went from 110 to 70, you lost $40. But at least when you did a covered call, if NVIDIA went from 110 to 70, you lose $40, but you've collected $5 in premium, so you've only lost $35. So with scenario A versus scenario B, it's still better to be an option investor. So actually, selling a covered call will make you safer than just investing in stock, because a stockholder is going to lose more. So when you buy stock and the stock goes down, you don't have cushion. So yeah, selling covered calls is safer than just investing in stocks. And this is where covered part comes into play, and that's where the name covered call comes from. You already own the stock and you're covered. You sell a call option, so you're covered. If it goes up, well, you'll have to lose your shares. So that's why it's called the covered call, and there's really no dangerous situation. Okay, so if it goes down, that's pretty much the worst that can really happen. If it goes up a lot, you can't really lose because you're covered. You have the shares. So if it goes up from like 110 to $710, that probably can't happen in a year. That would be extremely weird for a high market cap company that's already worth almost 3 trillion. It's like 2.5 or whatever. To go up 7 times would be impossible. But you get the point. If it were to go up a lot, you wouldn't really lose any money, but you wouldn't make the money. Like, you wouldn't be able to participate above $120 per share, which again is fine because you would make 14% in a month, and NVIDIA or any stock's probably not going to 7x in 1 month. But keep in mind, if you're really, really, really bullish, you probably wouldn't want to sell a covered call, or you would want to go higher on the strike price or sell like a lower delta, like a very small delta. That way you get income, but you still have a lot of upside, and it's really far from the current price of the stock. Now, let's talk about choosing the strike price for a covered call. There's a few ways to go about this depending on your goal. If you're looking for maximum income, you might choose a strike price that's closer to the current stock price. So again, we can actually go back to the NVIDIA example. If it's 110, you might just want to sell a 112 or a 115 strike price because it's going to have a lot of income. Now, this gives you a higher premium, but it also has a higher chance of getting assigned. So if you'd rather give your shares more room to grow, you might want to choose a strike price that's further out of the money. And that premium will be smaller, but the odds of assignment also drop, so you have more room for upside. So there's no perfect answer, and everything is a trade-off when it comes to option trading. And the expiration date works the same way. Shorter expirations like weekly or 2-week options give you quicker paydays, and they're a lot more flexible, but they also require a lot more work. So you might have to adjust the position, close the position, and you're just more actively trading, which kind of isn't the passive income system that I personally built and I personally follow. I try to reduce the workload and make less decisions, because when you're making more decisions, you're likely to make mistakes. Now let's talk about stock selection for covered calls. The moment you start selling covered calls, you realize something very important. This isn't just about owning stock, it's about owning the right stocks, because not all stocks are created equal. When it comes to generating consistent income, you want a stock that has good momentum, a stock that is basically cooperative with the covered call strategy. And good momentum just means that the stock has had positive results and it's likely to continue to run up higher. When a stock has, multiple months of good performance, that's a very good sign. When a stock is all over the place and it's like this, you probably don't want to do a covered call strategy. The best covered call stocks are the ones that give you decent premium without massive price swings. You want boring, you want steady, you want reliable, because remember, the goal is to generate consistent income, not to hit a home run. If you want to hit home runs, well, you got to probably buy some call options and hope that timing works out in your favor. One of the most important things to look at in terms of a stock, that it doesn't have huge and wild gaps. So a gap is basically when a stock goes from 80 to 90 real quick. And yes, it's not always good if a stock is going up a lot, because the covered call strategy is for consistent safe income, per month making 5%, let's say. If a stock is gapping up and it went from 80 to 90 and it basically has a more than a 10% increase in a single month, it can still be a good covered call to do, but, probably you're going to leave some money on the table because it has a very high amount of volatility and it's rising a lot. Then again, if the stock is up a lot over the past month, you probably didn't get assigned when you sold your put. So you wouldn't even be able to do the covered call to begin with. So you wouldn't even be really in this situation. But keep in mind, you just want stability. You want a stock to positive growth over like 3 to 6 months, but you don't want a stock to be up like 90%. Although if it's up 90% and you actually believe in the stock, there are situations where you can sell puts to get assigned at a cheaper price. But oftentimes, I've just noticed that those are a little bit more risky positions. But when it comes to large cap established companies, I want to say that there really isn't a bad time. If you look at Microsoft, Apple, Amazon, all the money is going to these companies. And these companies, not only they are innovating, they're just dominating. So if you go for a company that's dominating, it's good for both selling puts and covered calls. So, starting off the strategy by selling puts, fantastic. And then generating money with covered calls is great as well, because these Mag 7 stocks, they are typically moving up over a long period of time. Of course, in one single month, you can have some issues, and maybe that's like a tariff issue with Apple. Maybe it's some chip demand for NVIDIA. But in the long term, you're going to see a really good result. And actually, even if the stocks pull back, that's a good thing, because you get to buy more of them at cheaper prices. One question I get all the time is, what if I pick the wrong strike? The good news is there's really no such thing. Let's say that you pick a strike that's just too low and the stock runs up. You still make money on the shares and the premium. Let's say that you pick a strike that's too high and the stock stays flat. You still get to keep the premium and your shares, although this situation will be a little bit less than ideal because you will be making less income. And this whole free course is about creating enough income so you can retire. So you generally want to be a little bit closer to the money. So, 30 delta or 35 delta is okay as well, because you generally want to have a little bit higher income. If you go a little bit out of the money for a covered call, then you're not really making that much from option income. There's also advanced tweaks that you can make once you get comfortable. For instance, if your stock has run up quickly and you're deep in the money, you might choose to buy back your short call and sell a new one further out. This is also called rolling, where if you're nervous about a pullback, you might choose a lower strike price and actually move your strike price down to collect more income. This would also be an example of a roll. Let's show you an example of rolling a covered call up. Let's also show you an example of rolling a covered call down. Now, I do have a lot of covered calls in my portfolio right now. So let me go to total return here. A lot of my covered calls may be actually down right now because the market is doing very well. And remember, when the market is doing well, your covered calls will go into the money, and then it's a good time for you to roll them higher. So I'm going to show you a position that I have on Snap right now. So here we have Snap, and Snap's currently trading at $8.23. I am slightly down on my position. And I have two different positions here. I have 8.5 covered calls, which are out of the money, and then $10 covered calls, which are also very, very out of the money. Both of these positions expire in 2 weeks, so on June 20th. So here, Snapchat, 8.5 may happen and may not, and that's why the premium is 22. It's actually somewhat likely if I go into this option, the delta is probably going to be around 30 or so. And yeah, so it's 39. There's a 39% chance essentially of Snapchat expiring in the money here. So this is a pretty high chance, and there's really no action to be taken until much closer to expiration, because there's still a decent amount of premium here. In fact, there's a lot of premium here. Although I'm up 38% on the premium, $350, there's still a lot more premium to go. However, for the $10 sell put, it's already made, basically all of its money. So here, this is actually a good example of me being able to roll down a covered call to make more money. Here I'm up 88%. I'm up most of the money that I could make, right? There isn't much more money that I'm going to make on this position. So instead, I'm going to take profit early and close out this position 2 weeks earlier than expiration. And I'm going to roll this position. Okay, so I'm going to roll this position, and typically I like to follow a simple roll schedule of just going out to the next month, or it varies. I can sometimes go out 2 months, 3 months, but here let's just do a quick example what it would look like. So I can go from 10 down to 9, and that's still out of the money here. And if I click this right here, you'll see that I'm collecting a total credit of $650. So in 1 month, I'm collecting $650 on this small position by rolling it down. And I'm rolling it down again because Snapchat is out of the money, and $9 is still a good price to sell it at. Plus, if it goes into the money, I can just roll it up. Okay, so this is an example of rolling it down for income. All right, so this option isn't worth anything and I want to make more money, so I'm rolling it down where I can make some money. Now let's talk about the reverse scenario. So let's say that the option is in the money. Then in that case, what I do is I can roll it up. All right, so now I want to show you an example of rolling a covered call higher, and this is XLY. XLY is an ETF, and this is actually something that I trade very often in my Discord community. I'm trading XLY because it has a lot of stocks within it. So real quick, the stocks that it has within it are Amazon, Tesla, Home Depot, McDonald's, Starbucks, and others, right? And the reason why I like trading ETFs is a lot simpler. And like right now, I don't really want to hold Tesla. I just think that it's a little bit expensive. And it's so funny that Elon ended up having a fight with Trump, and now Tesla was down. Let's actually show you real quick how much Tesla was down and the benefit of owning an ETF. So Tesla yesterday was down a lot because Elon and Trump are just having issues. And they basically broke up, and now they're calling each other all kinds of stuff and what Donald Trump did and etc. Politics, blah, 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 right? But Tesla is down 17% in the past week, but the only position I have is the call credit spread position. That's the only position that I have in my portfolio. And I don't have Tesla directly because I have Tesla through XLY. And guess what? Tesla's down 17% in the past week, but XLY is only down 1.88. So it's really nice to not have direct exposure into certain really risky stocks, especially when you're looking for retirement income. And I personally believed that Tesla was overpriced, and I ended up being absolutely 100% correct. But of course, I didn't know the reason that it would, kind of crash was because of Elon Musk, although I'm not very surprised. There's just no surprises there at all. To be expected, to be honest. But look, here's XLY, and what's nice about it, and the position I have is 200 call and 205 sell put. Now, this is a position I'm going to explain in great detail right now. First of all, I have an in-the-money covered call, right? It's in the money. And what I can do is I can roll it higher and basically make more money by rolling it higher. Now, I don't really need to do that right now because this option expires in September, and it's really not that far in the money. But let's say that, for example purposes, I will show you how to roll this up and make more money right now. So this is a 200 call option. I am down money because it's, XLY is well above 200 right now. It's at 210. And what I can do, if I go to roll this position, and I don't want to do this yet, but I will likely do this, I can simply just roll it from September expiration to, say, December. I can go from, 200 to 205. And here you will see that going from 200 to 205 nets me a big credit, okay? And I am going up by a lot. So I'm going from 200 to 205, so that's $5 more. I'm getting a whole extra $5. And then in addition to this $5, I'm collecting a credit. So why is this trade so good? Why is it too good to be true? Well, it's all because of time. So I'm adding 91 days, and because I'm adding 91 days, an option is going to be worth more because there's more time. And because I am buying this option right now that expires in September, and I'm selling one that expires in December, now that this option expires later, it's worth more. So it's just simply worth more. And because it's worth more, I'm collecting a credit. So it's pretty easy to play around with this and basically sell covered calls. And if they go into the money, you just simply roll them up. And you can do that over and over again as many times as needed. And I've done this many times with Apple, with all the stocks that I really hold, as well as Walmart. I can show you a position on Walmart right now. Actually, it might be a great one to show you because Walmart is also very slightly in the money last time I checked. So 98, and I have a 95 covered call. So and it's actually interesting because I'm up on the position. So oftentimes when you collect a lot of premium, a lot of income from selling the covered call, even if it goes into the money, you can still be up on the position because maybe you have collected so much premium that you're still up on the position. So that's the case for me. I'm still making money on Walmart even though my position is in the money. And what I can simply do, again, if I go to Walmart option right here and I go to roll this position, then again, I can roll this position from August and I can roll it up. So let's say that I want to roll it up to 97.5, okay? So I can go from 95 to 97. Here, I am paying a total debit, okay? I'm paying a debit, and the specific amount of debit I'm paying is 17 cents. But I'm paying 17 cents
to move up from 95 to 97.5, okay? And Walmart is currently trading at 98.30. So I'm literally moving up by $2.50 and I'm paying 17 cents. Okay, it's just a big total debit because I have a huge position. But it's interesting because think about it. You're paying 17 cents to make $2.50 in basically 35 days. That is essentially a return that beats every single other return. That is the best return that you can possibly, like, are you kidding me? 17 cents into $2.50. That's like well over 10x return. So it's crazy. And that's how powerful rolling up covered calls is, especially when they are very slightly in the money, okay? Now, if they're very deep in the money, this still applies. You just won't get as much, you won't have as like this crazy return. But this is actually an example of a really crazy return. 17 going into $2.50, all right? Now, of course, in some cases, when a stock goes up a lot, like a tremendous amount, you may want to like roll it more and it's going to cost you more to roll it higher. In this case, this would be not necessary, but I could roll from 95 to 100, pay a much bigger debit, but have a lot more upside in case I believe that Walmart will run a lot more. This is not necessary in my opinion because I always go for slow rolling up. And a lot of times what I do with my clients is I'll just sit there and we'll just discuss what are the trade-offs, what are the returns, does this make sense to roll? And oftentimes we just pick a middle ground. We don't have to go for extremes here. We just pick a middle ground and almost always it just makes sense because adding more time to an option is just profitable.
All right, let's continue this retirement course. I'm filming over many days and I hope that you see the effort that I'm putting in and that you're liking the course so far. And if you are, leave a like on this video. So let's talk about some real examples and see how to actually manage a covered call trade. And the first thing is I don't want your greed, which everyone has. I have it, you have it. Don't let your greed drive your strike selection. That is the most dangerous thing you can do. And if you start going for the wrong strike selection, you will oftentimes get out of the stock because you'll get assigned way too often and you won't actually make the money that you're looking to make. You should only be selling at a strike price that you're happy selling your shares at. That is the ultimate best strike price that you can pick at the end of the day. And over time, your strike selection will actually become routine. So as you trade more, it becomes more intuitive and easy. Now, I want to go over an example. This is a little bit older of an example, even as I'm recording this video. Palantir is actually at all-time highs now at $130 per share. But I want to use this old example because it'll actually paint you the picture of a mistake that if you make, you will leave a boatload of money on the table. So here you can see that Palantir is at $88 and we're going into June 2025 now, but Palantir was essentially an $88 stock in March of 2025. And you can see here how I've opened up a sell call trade, and this trade is expiring January 16, 2026. Now, there's a lot here that we're going to discuss. The first thing is, of course, Palantir has increased so much in value that a covered call would have definitely underperformed versus just holding the stock. So no, these retirement strategies are very important to understand when to use and when not to use. Now, there's really no bad time to use a covered call except for when the market has had a really big, crash, a really big pullback, and a stock is trading for really low levels. And that could be, you can tell that by looking at RSI. You can tell that by looking at the Bollinger Band. You can see if the stock is well below the moving average, and these are all indicators that will tell you that, hey, this stock is undervalued, okay? You can see here how I wrote here more safe and more aggressive. So you can see that if Palantir is at 88 and you sell a 90 covered call, it's going for $21.85, right? Essentially $2,185 worth of premium can be collected by simply selling a call option. And you might be thinking to yourself, well, amazing, that's a lot of income. And that is a lot of income. But if you're looking to have the good income long-term as well as upside, and the stock is basically very low, you really shouldn't sell too close to the current stock's price. So Palantir was trading at 88. And you could have absolutely sold a $90 covered call option. And that would have been okay. However, because Palantir is now trading at 130, you would have missed out on some of the upside. Now, this isn't really a loss. You didn't really lose money. You still made money, but you've made a little bit less money than you would have by doing less work and not even selling a covered call at all. Now, of course, you can't predict the future, and it can be very difficult to tell a stock in the short term. We didn't know that from March to, mid-May, early June, that the stock market would recover so much. And that's not your job. You don't have to predict the market and predict the future to be a good option trader that can retire and create passive income. What you need to do is just create balance. And the balance is, instead of going for a high delta, so this 90 right here would be a high delta, give it a little bit of room to breathe, okay? So right here, the 97.5 still has a very good premium of 19.95, which is not really that much different from 21.85. Yeah, it's a couple $100 less. Essentially, it's $200 less. However, because it's $200 less, you actually get a lot more upside. And the upside is actually pretty insane. You can see here, instead of the 90 strike price, it's 97.5. Now, that doesn't fully change our break-even price by $7.50 because, of course, the premium is going to be less. But still, our break-even goes from 112 to 115. And that little bit of an extra $3 over, a 9-month period actually adds up to a lot. This actually represents an extra 4% upside return. And 4% every, 6 months or so is an extra 8% a year. And this might be crazy, but the stock market really only has 8 to 12% per year in actual return. So by using the covered call strategy on a stock like Palantir, which has higher implied volatility, that actually gives you a lot of income as well as upside. And the income and upside can actually add up to multiple times of the S&P 500's normal return. And this is how you can actually retire faster, sooner, earlier, and continue to generate income within retirement without the boring stuff. So what most investors are doing, right, is they either have index funds, which are fantastic. I will not talk down on index funds. They're great, but they're not really going to help you retire fast. They're just going to get you to retirement over 30 years, 40 years, etc., right? And while other investors are focusing on really risky strategies, such as buying options, and that's also not ideal. We're focusing on selling options in this course because selling is where the consistency is at. And you can see here, whenever you're running the covered call strategy, you always want to sell calls and you want to go for the more safe. I label this as more safe, but it really means that more safe from assignment. Assignment isn't always bad, especially if you're selling options, and we'll talk more about the wheel strategy soon. If you're okay getting assigned, which you should be since you can continue to sell options on a consistent wheel basis. Sell puts, sell calls, sell puts, sell calls. You're not really restricted. The only issue is a little bit of taxes, but hey, when you make money, you have to pay taxes. So when I say more safe here, I really mean more safe from assignment risk. You won't get assigned as often when you sell out of the money option. Now, what I like about covered calls is they also give you a lot of control. You get to pick. You are choosing what strike to sell the call option at. So you get to set the terms. You're in full control. Hey, I want to sell at this strike. Good, I'm picking this strike. If I don't want to, I can go higher and higher. You get to choose and pick. And it's very reliable. It's a repeatable passive income, and it's simple. And so all you have to do is really just make a smart decision, and you're basically done. You can kind of hands off, let the position run and do its thing, which is what I love about selling options. They're so simple. There's very little management. And with little management, of course, that makes it great for retirement. So you can have the freedom in your retirement without having to trade and look at your portfolio all the time and manage positions. And that's not really suitable for retirement lifestyle. So yeah, I don't prefer the buying strategies or really over trading. And plus, over trading and buying strategies and trading more and looking at your portfolio more will not get you more and better results. So keep that in mind. Now, next we're going to cover what happens when a covered call expires in or out of the money. So I need you to understand covered call outcomes at expiration. So let's talk about that. When a covered call expires, there's really only two outcomes, okay? Either it goes into the money, all right, and it's basically you're going to get assigned
because the person's going to exercise. When it's in the money, that means it is above the strike price at which you sold. So let's open up my beautiful portfolio right now and let's take a look at a covered call position, which, I've sold a covered call option that is basically in the money. And we can take a look at ACHR right now. You can see a pretty big loss on the option. However, this just means that it's in the money and I'm going to sell off my shares. My actual average cost on ACHR is below the $9. But because this is a stock that I've talked about in my Discord community a lot, I'm very bullish on, it has performed very well. So I've done a very good job, but I've left some money on the table. That's completely okay. I'm not going to get greedy. I'm happy with my results. So ACHR, I have the $9 covered call, and it's in the money. So this looks really bad, but again, I'm up a lot on the stock and my average cost is much less. So I don't have to pay this. It doesn't really mean anything. It just means I'm losing my shares and I've left $17,500 on the table. Couldn't predict the future and I've made money, but I made less money than I could have, right? In the grand scheme of things, this was very good. I've made money, happy with the position. Again, I want to restate that because some people may look at this and say, you're losing on the position. No, if I was buying back this position, then I guess you can say like I've lost some money, even though I'd still be compensated more because I'm up a lot on the stock itself and I have the shares. And that's why this strategy is called a covered call strategy. You're covered, so it doesn't matter. This could say negative $1 million, but I would be up $1,050,000 on the stock, right? So it's proportionate. They move together, but I made a bit more money on the stock itself. So I want you to understand that, and I don't want you to be concerned when you yourself see a covered call as losing money. It's not really losing money. It's just upside that you've left on the table. And that's completely okay. You don't have to do or take any action on that. So here is ACHR. It's in the money, and essentially, I'm going to be losing the stock because it's at $12 per share. So anyone that is holding this call option is going to exercise because they get to buy it at $9 while the stock is at $12.70. So this was a very good position for the person that had bought the call option. But it's also a very good position for the person that sold this covered call option. Now, in scenario 2, let's talk about out of the money option. So when an option goes into the money, you still don't have to really do anything. You let your shares go, okay? We'll talk about rolling later on in this course, and rolling will be very interesting as well. And I'll teach you how to not let go of your shares, to not pay taxes, and to manage your position more effectively. But, I really want to do step by step and build up your foundation because this course is the only course that you really need to understand how to retire and use all these strategies. So I want to build up your foundation step by step. So we've talked about in the money. Let's now talk about out of the money. So let's take a look at my portfolio. I have many positions expiring in June and July. Let's talk about out of the money, and then I'll show you a really cool example of an in the money option that is still making me money. So I can explain to you many different angles here. So let's go over SoFi right now. SoFi is currently trading for $13.51, and I have sold 15 covered call options. So these options are currently up $60. Nothing crazy, but they're out of the money and they're producing income. So I'm up $60 right now. And essentially, when a stock is below the strike price of the covered call, that's good. Every single day, basically, it's going to be losing value. And because you've sold them more expensive and every day they're losing value, the value that they're losing is the money that you're collecting. That's basically the money that you're making. Okay. For example, let's say you sold something for $1,000. You can see on the screen right now. And then the theta, let's say, is basically $100 per day. Okay. When you sell an option for $1,000 and theta is $100, that means every single day it's losing $100. So after day 1, day 2, it's going to be worth $900. You might be thinking, okay, well, what does that mean? Well, you sold something for $1,000, you got paid $1,000. The next day you can buy it back for $900. So that means that you've made $1,000 up front, and then you pay $900 later. Okay, so then you have a profit of $100. But you can also wait 2 days. So 1,000 minus 100, and then the second day you lose another 100. So now it's at 800. So you can buy back the option for 800. That means you've collected 1,000. Now you can buy it back for 800. You have a net profit 200. You can basically see what I'm doing here. Every single day when an option decays, that decay means that that's basically money that you've made, right? So you've collected the money up front, but of course you still have a position that is in your account. And that's why oftentimes when you sell a covered call, your account balance doesn't go up right away because you still have the position in your account, and that position is a negative position. So it kind of balances out. But every single day, that position goes lower and lower and lower in value, and then your account goes up, up, and up because it's cheaper and cheaper for you to buy back that option. Or at expiration, you essentially don't have any more obligations. You're done, right? And if that option is out of the money, then you're good, right? All the money that you collected up front is now officially kind of I'll call it officially, is officially yours to keep, and you don't have any more obligations, you don't have any more positions in your account, and then you can sell another covered call option. So as long as it stays out of the money, you really don't need to do anything. You're good. So SoFi here is out of the money and I'm up $60. And essentially, I can even click here and simulate a return. As long as it stays below $15, which is the strike price, you can see here how the simulated return will only continue to increase until I hit my max profit. So right now, essentially, I'm right here, which I'm making this video on like, mid-May. And as time goes on, it just continues to make money, and this is all through data. This is all through like the time decay. You can see here, as long as it stays at 1351, I'm good, right? At expiration, I made my max profit. Now, let's say that the price starts to kind of slowly go up. So let's say that it goes up to, let's go to $14.25, okay? So if I click enter here, the chart changes a little bit. So now I won't really have as much profit right now. In fact, I'm very little profit for a long time because $14.25 is closer to $15. So because it's closer to 15, which is the strike price, there's a bit more like risk of being potentially assigned. And because there's more risk, then this option is not going to decay as much because it's getting closer to what investors want it to do. That's why they purchased the call option, right? So the expectation will be like, hey, it may go into the money. There's a higher chance. And that's why you see here $14.25 means that the premium is going to go up over time, but not as fast, but really, really fast in the last few days, right? Now, if I change this to 14.89, for example, you can now see that I will actually be losing money. If SoFi were to jump up to 14.89, I'd be down money because it's super close and very probable that it'll go up above 15 with all the time left. So in fact, I'll be losing money and this option will become more expensive. And yeah, I'll only kind of break even after like 2 weeks basically. And then you can see here how it really exponentially quickly decays as long as it stays out of the money, right? So you can essentially see that's how it works. And if I go 14.99, then yeah, essentially it's super, super close, but then exponentially there. Now, if it actually goes up to like 15.60 and goes into the money, then I'm going to be very, very red, right, for the entire time. And the only reason you can even see I have a little bit of green here at the end is because I actually collected more than the 60 cents when I sold the covered call options. And that's why it's still going to show I'm making a little bit of money, but not that much because if I recall, I guess I sold the covered calls for 70 cents. Or actually, because I have 5 contracts, about 62 cents. And then this is showing a $10 profit because 2 cents times the 5 contracts is $10. So this is how it looks like, and this is like really a masterclass on outcomes of in the money versus out of the money. So of course, if it goes in the money, you don't have to do too much yet, but you may want to consider closing the option. If it goes very, very in the money and it goes against everything that happened, you can close out the entire position early. And again, remember that just because this is showing a red negative, this is just showing you the short call. Obviously, the stock is also going up, so you're not really losing money. They're just moving together. So I need you to understand. And I'll show you an example right now. So let's go over an example. Let's say that SoFi goes from, $13.51 per share to $14.51, right? Well, what will happen to the stock as this loads here is that essentially, because I have 1,700 shares, I'm going to make $1,700, right? If it were to go up by $1, it would go up by $1,700. But my options, my covered call here, would also move up in value and negate some of that, right? But it's not going to negate all of that because when you hold stock, it's a 1-for-1 move, right? $1 move means I make $1 per share. That's $1,700 again. But for an option, they're not moving 1-to-1. So an option moves by the delta. So the delta here, right, if I scroll down, is 0.35. So when the stock moves up by $1, this option is only going to move by 35 cents, right? So even if it goes into the money, if the stock goes above the strike price, it goes into the money, yeah, the call option is going against you. You're losing money on the call option, but you're making more on the stock itself because there's a 1-for-1 move on the stock itself, but there's not even close to a 1-on-1 move on the option. Even if it's in the money and it has a higher delta, it's still not a 1-to-1 move. So in this case, even if SoFi went up a lot, $10, it would went up a lot, then I would make $17,000 on the stock, but the delta would basically be, the delta obviously changes, but you might lose, let's say, for example purposes, $10,000. So I made $17,000 in the stock, I've lost $10,000 on the options, and I'm up $7,000 total net profit. So this is an extreme example, and I'm telling you that even if the stock skyrockets,
you still have profit. You still have a net profit. And that's because a covered call is a bullish strategy. It's pretty hard to lose on a covered call. You really can't lose. You can only really lose mentally if you say, hey, the stock went up a lot. I wish I would have done this. Well, yeah, that can happen. Yeah, that's really the only risk. The other risk is the stock can fall down a lot. And yeah, if it falls down a lot, well, yeah, you lose money, but you still lose less money than the stock investor. So this is still such a beneficial strategy. And I just really wanted you to understand the difference between in the money and out of the money. And so here's a little quick recap before we move into our next really important section. Out of the money, stock price is below strike price at expiration. Option expires worthless. You keep your shares in the premium. No action needed. Ready to sell another call option. When it's in the money, the stock price is above the strike price at expiration. The option is exercised and your shares get called away. You sell at the strike price and keep the premium, okay? And the total profit is a stock gain up to the strike price. Can't make more than the strike price plus the premium that you collected. And here's another visual example, by the way. So if you own 100 shares of Amazon at $195 and you sell a $200 call option, you collect $200 of premium. Then basically here you are, you're at $195. Your call strike price is at $200, and you have a $5 upside. So it can move up by $5. So at expiration, Amazon goes up to $202, let's say. Well, that's your max profit is at $202 because you can go from $195 to $200, and then add in the $200 of premium, which is essentially $2 per share because each contract's worth 100 shares. Your break even is $202, and that is your max profit. So you can sell your shares at $200, or you will have to sell your shares at $200 if Amazon's above $200 on a covered call. You have $500 of profit. You have $200 of premium that you've collected. So you have a total profit of $700. You miss out on all the gains above the strike price, but the strategy is about consistent, predictable income. So you're not really chasing unlimited upside. That's buying call options. If you want unlimited upside, you will go ahead and buy call options, and I can assure you, you will have a very wild ride without much consistency. You may get lucky. You may make a lot of money short term. You're almost certainly likely to lose a lot of your gains by getting greedy, and because the market's not predictable, you're going to lose money. And instead, the covered call strategy is very, safe, it's passive, it's consistent. So it's literally the best strategy for retirement. That's why I'm focusing a lot and helping you understand this so you don't waste more time watching other videos. You just really understand everything here in one video. So if shares get called away, you now have cash either to rebuy the stock or to basically pick a new stock. You don't have to pick the same stock. You can recycle your money and reinvest it into other assets, other covered call positions, or selling put options, or buying stocks, or there's anything really. Your capital is free. So at the money, at expiration, the price and the strike price, when they're equal, the option is typically going to be exercised, right? Even if it's right at the money, you basically have a 50-50. Maybe you'll get exercised, maybe you won't. It's obviously very rare for the stock to end exactly at the strike price. So if it's very, very close and you don't want to lose your shares, then you can, of course, on the last day, the last day of the morning, the Friday morning, you can absolutely close the option contract so you don't have the risk of getting assigned if it's like right there, right? Where you can close it and open up a new one, which is basically called rolling. You can do that one transaction as well, which we will cover later on in this course. So here's the plan for assignment if in or at the money to avoid surprises. If you want to avoid assignment, you can buy back the call before expiration and close out the position. Most of the time, it's fine to let options expire naturally. All just very simple and passive. Let them expire. That usually is like 90% plus of the time when I'm trading. I just let it expire and that's it. So if you don't want to risk selling your shares, sell calls further out of the money for lower premiums, but more room for the stock to grow. Covered call outcomes are clear and defined, so no surprises if you understand the process. You really won't ever be surprised much. Now, here's scenarios to watch out for when selling call options. And there's basically two main problems. The stock drops after you sell a call option. Again, I mean, the markets do their thing. If the market drops, it's fine. Don't panic. We've obviously seen the market do some crazy things, and that's fine because it recovers all of the time. Like I'm going to go to NVIDIA right now because I just want to show you the amount of volatility that stocks can have. I mean, NVIDIA started 2025 at 149, and then basically the stock went down to $94 per share, only to recover back up to 132. And then a lot of people, and especially if you're,
looking for retirement or you're close to retirement, I can imagine you would panic. And this is another reason to have me as your coach, is to really get you into the right mindset that this stuff happens, and no matter what the economy is looking like, stocks will pretty much always recover and do really good in the long term. So yeah, you don't need to panic when the market really pulls back, because covered calls at least give you some cushion. They give you cushion on the downside. Now, you do need to be careful, because if the stock falls down a lot, you don't really want to be selling call options like right here, because then you lose a lot of the upside. So we will be talking about managing the covered calls and rolling and all that good stuff. Again, later on, it's going to be more advanced, and we still need to build up some more knowledge before we get there. So if the stock drops, options likely expire worthless, which is good. Your shares will take a hit, but you get to keep the premium, which will lower your cost basis. If future premiums are too low, what you want to consider is rolling to a lower strike price with a longer expiration date. Again, we'll go into rolling and all of that pretty shortly here. So the stock dropping isn't really a failure. It is what it is. It was going to drop anyways. Now with the covered call, at least you have some income that you've collected. So the premium cushions your losses. Now, if the stock rises quickly, you're going to have to understand how to manage this position. And a couple of your choices are that you can do nothing, let your shares get called away. If it is below your cost basis, again, this is more of a complicated special case. We'll talk about it, because that is basically the hardest part about this strategy. That's the hardest part, is when the stocks do pull back, do you sell more covered calls? The simple answer before I get into the rolling section is no, don't sell covered calls, just wait for the stock to recover. Okay, that's like the simple kind of answer there. But you can also sell covered calls, and you can always buy them back. So you can buy them back and sell new covered calls. So you can sell a new one with a higher strike price and later expiration. And you can actually continue to do that for a very long period of time, very, very long period of time. And you can do that for a credit or a debit. And that will depend. And I'll tell you the different scenarios that you should do a debit or a credit. But yeah, basically your gains, it gains you more time and room for the stock to rise. So when you're rolling, and when you're closing a position, you want it to make logical sense. Are you happy with the roll to close out one position for another? And I'll tell you right now, a credit is obviously good. You're like, oh, credit's good, yeah. But a debit can also be good. A debit can also be good as long as it meets certain criteria. So let's go over a quick example. Keep it really short and simple on rolling, and make it a quick example here. So let's talk about rolling a position, and we can go into my portfolio right now. I've had actually some options that have recently expired, because this Friday was a really big expiration event, and now this Monday I have a lot of shares that are available. But let's go to XLC, for example. I have XLC. This is a really good ETF. XLC has holdings in Google and Meta. So instead of me having shares in Google and Meta, instead I'm just trading XLC right now. And you can see I have a 97 covered call, which is currently at a bit of a loss, but I can easily make this into a gain by clicking roll this position. If you're using a different brokerage, you can either right click, maybe there's a rolling option, or you can simply close out one position. You can close out the position and open up a new one. And that's essentially all that rolling is anyways. So it's pretty straightforward there. Now, June 20th is the current expiration. And if I were to go for something like September, this would add some time to the option. So adding time to the option is a really big factor in the premium being more. So here I can go from 97 to say 100. You can see that I'm going from 97 to 100. I'm adding about 90 days or 3 months, and I'm collecting a net credit of 50 cents, or a total of $2,500. So I'm essentially getting paid to move up my strike price, which is amazing. I mean, this is such an amazing trade. This is a no-brainer trade. You don't even need to understand much math. You can be a 5th grader and say, hey, I'm going to give you more upside, and I'll pay you for it. Of course. Why not? Sure. Of course. So this is an example of a really easy roll. Very, very simple roll right here. Rolls can get a little bit more complicated when they're deep in the money. So if you sell a covered call and the market recovers a lot very quickly, then you can start getting into a little bit of trouble. And I guess we can go over my position on Palantir. And I've been rolling this up and up. You can actually see this option. So I don't have more history on this because I've traded it a lot in different transactions. But let's just kind of go over this then. Let's look at rolling this higher. So if I wanted to roll this higher, I'll show you what a debit roll is going to look like. So if I go to roll this position and I go from, let's say, the September, and then we just go into something like January, but I'm looking for January 2026, not 2027. Let's go to January 2026, right? So I'm going to add about 3 months to this position, and I'm going to go from 85 to 95. Check it out, all right? This is a little bit different. Same strategy, but you have to understand. So I'm going from 85 to 95, right? I'm adding 4 months, actually, 120 days. Now look, it says total net debit. So I'm paying a net debit of $2.35, right? Now you might be like, I don't know. I don't really want to do this. I'm paying a debit. But check it out. Palantir is at 125 per share, right? You can see right here, 125. And we're at 85. We're moving to 95. We basically get almost a guarantee that Palantir will be above 95. It's not guaranteed, but it's very, very deep in the money. So I'm going from 85 to 95, and I'm collecting a total value of $10 like that. Like immediately I'm getting $10, right? In the money. It's not maybe, we're deep in the money. And I'm paying $2.38 to get this $10. We don't even need to be geniuses here. $2 turns into $10 in 119 days. You pay 2 to get 10. If I told you, let's forget this position right here, and if I told you, give me 2 and I'll give you 10, I will 5x your money, I think that you will be so excited. You'll be salivating like a dog that has a huge bone, right? This is why it's okay to pay a net debit. Now, how do you determine if it's okay or not? Because this one's obvious, right? $2 into 10, there's no math required. It's 5x. But how about other situations where you have to pay $4.50 to make $5? Is that worth it? It really depends on the time frame. So in one day, $4.50, if you pay it and you get $5 in the same day, of course. If it's in 1 year, not so good, right? So it's really about the return in the time, and this is really what I get more deeper into when I have a calculator. In my Discord program, I have a calculator that goes over this in training on what makes sense. When do you want to do this and how much is okay? And what does that hurdle rate look like? So a little bit more advanced, but I go over that in my Discord community, which is the first link in the description if you're interested in that. But basically, this shouldn't be too hard. You should understand how to do it. But yeah. All right, so let's get into this section right now, scaling covered calls for monthly income, and continue this masterpiece of a retirement course. So you must own stocks in 100 share blocks. So we'll talk about Apple, Microsoft, Google, Amazon, and Palantir. So selling one covered call per stock each month, you can generate $50 per trade. And if you combine, right, all these different stocks, it becomes $300 to $700 plus with multiple positions. Now that's just one covered call. Imagine if your portfolio, as it continues to scale, or let's say that you're already working with a 6-figure account, these numbers can start to scale to $3,000, $5,000, $10,000, and more. Especially if you're reinvesting your premiums, that's how you get your account to grow really fast. Of course, many people that are retiring, they're looking at withdrawing the funds and using the funds for their lifestyle, for expenses. But if you can reinvest premiums, as you sell options and you put them back in your portfolio, that's really how you get the compound interest. And that's how you scale and grow a portfolio very fast and build that wealth that you're really looking to build. So you use premiums to buy more shares. So when you sell options and you collect, let's say, $5,000 or $7,000 for that month, you can use that premium to sell more covered call options. So you can buy another 100 shares of a stock and sell some covered call options on that stock, which will bump up your income. And essentially what you want your portfolio to look like is kind of like a dividend portfolio, but much higher income. So with dividends, oftentimes in 1 month, you might get, let's say, 8,000, and the next month is $8,025, $8,075. And it's very, very stable and passive, but slow growing, right? Now, with option trading, what you want to see is, for example, you have 8,000, and then it's 8,400, 8,700, 8,900, 9,200, 9,500. And it kind of looks like this, right? So it looks like this. And that is compound interest. And what you want to do is you want to try to fit in the premiums to buy 100 shares of stock. So one of the mistakes I see is someone buys 23 shares of a stock or 78 shares of a stock. Well, you need solid 100 blocks of stock so you can sell covered calls. And here's a little bit more about like earnings that you can expect to make. And I'm going to go from conservative to basically less conservative and higher on the income. Let's say that you have a $50,000 portfolio and you aim for really just safe, boring. You have a job and you have a long time to retirement. You're not aggressive at all, and you just go for 2% return. It's basically going to be $1,000 a month. If you had 100K, it'd be $2,000 a month, and if you had a $250,000, it'd be $5,000 a month. However, in my Discord community, and what I'm seeing with students is oftentimes they'll come in, they'll implement my strategies, they go more aggressive, and they're getting returns that are 5%, maybe 6% or more, especially in good months. We obviously have months that are 14%. We have some students that have turned in very small amounts of money into very huge sums of money. But again, because I'm making this YouTube video free and for everyone, I want to be a little bit more conservative. So although 5% plus is possible, I would say a good standard for retirement is going to be the lower, the safer, the higher, the riskier. Let's talk about 5% a month. If you have a 100K portfolio, that's going to be $5,000 a month. And some of the students that I have that I've coached with boot camps, I no longer run boot camps, but I had a boot camp and a student named Denny. He was just selling puts, nothing else. He just focused on selling put options, not even covered calls, not even the wheel, just selling puts. And he had a very long stretch of time, over 12 months in a row, of $7,000 a month returns. I'm not keeping up with his results at the moment, but I was keeping up for one whole year, and there was just every single month $7,000 a month. And he wasn't growing like this. He was in retirement, so he was taking out every single penny, all $7,000, which I think was great, right? He was just very consistent. One trick pony, we call him. So again, yeah, this income can be used to cover bills, rent. Really, you can even go to lower cost countries. I want to stick to the point here, but real quick story is I've traveled all over Eastern Europe. So I've been to, recently I was in Estonia, I was in Sweden, Poland, Moldova. I've been all over, Vilnius I want to go to. So I've been all over Eastern Europe primarily. That's my culture, and I speak Russian. So yeah, I've been all over the place, and that's because of the trading income. It's all online, so there's a lot of flexibility in time. That's why you'll see I keep filming in different areas. I don't have a studio. Because of the income, I'm able to travel and have the freedom, so you can move around and go to places that are cheaper if that's your goal, or go to places that suit your needs where you're treated best or treated better, right? Time commitment. So this is not fully passive, but it's incredibly light management. Like, the management of options is so freaking easy. Like, it is so easy that I'm filming in different locations all the time. And it's because I have enough time to travel and trade and make content and coach, because I'm incredibly time efficient. And that's because trading, it's really only, I trade 45 minutes on Monday, 45 minutes on Wednesday, and these are my only real 2 trading sessions. And on Friday, I do an update in my Discord and I say, hey, this is what happened this week. And oftentimes, because we're successful, Friday there's no update. It's just like, hey, have a great weekend. Enjoy the profit. Go eat some lobster steak, or enjoy with your wife or your kids, etc. Right? So the time management is very low, and I think that's why I'm working with a lot of doctors, dentists, lawyers, and business owners, because you guys are incredibly busy. You have the capital to invest, and you have that growth mindset. You're like, hey, I want to grow my wealth. You're light on time, and this is really the perfect opportunity because the time commitment is so low. This is the lowest time commitment I can think of to generate $10,000 or more per month. Plus, doctors that are generating $20,000, $30,000, $50,000 a month, and the management is incredibly low. So if you actually even trade weekly in my Discord community, I'm going for monthly trades, and I believe that monthly trades are more passive, they're easier, and they're simpler, and I don't want to overtrade. But even if you go for weekly trading, which I also do as a coach and teacher, I'm looking to get more activity in, because I want the students to get more reps under their belt. That's weekly trading. But even if you're weekly trading, the time commitment is still really low, very minimal amount of time. So keep in mind, as time goes on, not only does the time investment also go down, there's almost no time investment. I have seen students that just sell 3 months out and then that's it. They look at their portfolio once a quarter and they beat all the professionals because they're using the strategies, the deltas, the technical analysis, the fundamental analysis that I teach. Really as simple as that. But yeah, optimizing over time. So tracking the best paying stocks or months. You see what you've done right, and then you just continue to double down. It's just continually optimizing and improving your trading strategy. So when you find a winning formula, which I've already found, I found it for a long, long time, and it is difficult to find, I'll tell you that. The money game is one of the most competitive games in the entire world because everyone wants money, right? Not everyone wants a nice car. Most people do, but not everyone wants to travel. Not everyone wants to whatever, right? But money, everyone definitely wants money. Even rich people want more money. Poor people definitely want more money. And middle class and working professionals, you're almost definitely a working professional. You also obviously want more money. So finding and optimizing the best solution here is the best, and it can be very difficult, especially if you're doing it alone. One thing that you want to watch out for is implied volatility. So watch implied volatility for any premium spikes. So sometimes premium will just jump up. I'll show you an example right now. So we'll jump into my portfolio as I'm making this course over time. And this portion of the course is, we're in approaching June 2025, and for NVIDIA specifically, they do have earnings coming up, and earnings is going to be a very important date for NVIDIA. So if you're trying to create, retirement income, passive income, it's still very important to watch out for earnings. So earnings here on May 28th. So that's going to be this week as I'm recording this. And once earnings comes out, it readjusts the metrics fundamentally for the company. So for example, Wall Street has models. So they're modeling companies. They're looking at the cash flows. In a company, the real value of a company is all of its future cash flows discounted to today's present, okay? And when earnings comes out, if earnings are above expectation, then all the analysts and all of Wall Street say, hey, we have more money coming in than we thought. There's more money coming in today. And that's also a likely metric that the future money is also going to be higher. Things are better than expected. So that actually adjusts the stock a lot. Because even if a stock has 3% more revenue over a long period of time, 3% every single year discounted today can be a huge chunk of money, and that can move the stock. And for NVIDIA specifically, what I'm looking at is a data center revenue. Data center revenue is the biggest portion of their business, 74% if I recall. And depending on what the earnings quarter is, that is going to be a number to really watch out for. So when it comes to retirement and managing, it's really looking out for implied volatility spikes and certain events, and earnings is the biggest event that you should really be watching out for. So you can see here NVIDIA has beat earnings multiple times in a row. So it's likely to do so again, just because of the winner effect or the bias towards winners, which basically states that when a company continues to beat, it's likely to go on and to continue to beat even more because of positive momentum and market force factors. So you really want to optimize for earnings and look at premium spikes, which I do all this work for you if you decide to do the coaching. And that is the first link in the description. What I do is I do the research for you. I enjoy this stuff, and this is my hobby, my passion. This is where I have 100% of my net worth, 100%. I don't own a real estate. I don't own anything besides options, and then I take out money as needed, and I fund my lifestyle. I have no other investments. I'm 100% option trading, so I eat 100% of my own cooking. I'm not saying do this and I do something else. I am doing exactly what I say. In terms of authenticity and transparency, I hope that comes out from me. I'm just super excited about this stuff because I think this will be life-changing for you. Now, let's keep moving on here. So in terms of diversification, it's incredibly important. Oh, I just had to sneeze. And in the Slavic culture, when you sneeze, that means it's the truth. So yeah, diversification is very important. So spread calls across multiple stocks and sectors. Absolutely, guys. I personally focus a lot on software and tech. That's my experience on Wall Street. I had a lot of experience in software and technology, but also had some experience in restaurant space and consumer discretionary. So consumer discretionary, think of Starbucks, think of Nike, and think of the personal brands that many people buy. So here we have some pictures of some stocks and diversification. I made these pictures specifically a little bit different. So I put in some stocks that are a little bit iffy, like Beyond Meat, it's a little bit iffy. Is the stock really a good company to invest in? Well, when you have proper diversification, you can take small bets on riskier stocks and still have low volatility in your portfolio and still be in that retirement zone and retirement income without really taking on a whole lot of risk when you're very diversified, right? Even if you have some China exposure, etc., right? The key is to stay disciplined and don't really chase the high risk premiums per se, because there's a lot of trash companies and be very careful. There's a lot of YouTubers, first of all, many copying me,
Many have learned from me. And then unfortunately, many on the scamming side. So they will look to push the agenda that you can make a ton of money very fast, very easily. But look, beware. As far as I'm concerned, I take advice from no one unless they're a billionaire. So there's almost no one on YouTube. There's a couple of channels that own brokerage firms. I would only really look at those. Because, the truth is, the only person that's going to look out for yourself is you. So if you want to be good in retirement, you really got to look out for yourself. Your wife's not going to help you. Maybe she will, maybe she won't, but you got to count on yourself. You got to drive the results yourself. No, YouTubers are really, I'd be very cautious. I'm giving you this course for free because I really genuinely want to teach you what I know, because I've achieved retirement, and I'm not selling you a course or a Patreon or a free webinar or anything like that. I'm giving you this info for free so you can replicate and get similar results to what I have gotten, okay? Be careful. Take off your beer goggles and focus on consistency rather than chasing high premiums, okay? Stick with high quality stocks that you are comfortable owning. So when you sell a put option, you get assigned, you literally don't give a flying you-know-what, because you're okay. You're happy owning the stock at that price, okay? That is the most simplest solution to never losing in option trading. You can't lose if the worst case scenario is getting assigned the stock that you want to buy. And also, and the next here is keep cash handy. So 10 to 20% cash allows you to buy more shares on any price drops. If any volatility happens, then you can implement your dry powder into the market. If you're a beginner, having cash available is key. If you are a bit more advanced, you want to scale faster, using margin is key. But I will not cover margin on YouTube here. Absolutely not, as you can get in a lot of trouble. So that is something that I only cover privately. But keeping it simple, have some cash if you're a beginner. If you're not a beginner, you have some experience and some consistency, then you actually don't need too much cash. What you can do is you can be fully invested and use the premium that you're generating as basically the cash that's coming in, or the future cash that will be coming in from selling options, and then just reinvesting that over and over again until you get this blow up in wealth, which is, I hesitate to say guaranteed, because there's nothing in life that's guaranteed, but this is as close to guaranteed as it is. This is pretty much guaranteed. You're going to get an explosion of wealth because the market is a proven way to make money. And yeah, the government's obviously printing more money. More money goes into the economy. GDP goes up, which is a common trend. Stocks become more valuable. Pretty easy there. The bottom line is to scale, you need to just have more covered calls. As you have more covered calls and generate more income, it's slow, steady system for financial freedom by reinvesting those funds. Yeah, of course, you have to pay bills and all, but the more you can reinvest, the better. Now, I do want to briefly cover my double dividend strategy. This is a kind of a key retirement strategy as well, especially for the bigger accounts. So we, in this course, will cover small, medium, and big accounts, and I'm giving you the full life journey here. So if you're not a bigger account, this is still important for you because you will eventually be a bigger account. This is what I call the double dividend strategy. As far as I know, I've created this strategy, or I've come up with this name. So the double dividend strategy looks like this. Your goal is to collect regular dividend income plus option premiums on the same stock. So you want to pick stocks that have really good premiums. I'm going to show you KHC, because for me, KHC or Kraft Heinz is really the prime stock that I would be essentially looking at to run the double dividend strategy. And Kraft Heinz is, in my opinion, one of the best stocks to do this on because it already has a 6% dividend. So with a 6% dividend, that's already a lot of income that you can collect per year, but also Kraft Heinz is very stable. So if I go to the 1 year return, it is actually negative 26%. And when I say stable, I mean stable going forward. In the past, it has not been as stable, although I've very consistently made money with Kraft Heinz despite this, because I've personally sold in the money covered calls, and I've created collars on this stock. We'll talk about that a little bit later, but you can see here that over 5 years, Kraft Heinz has essentially done really nothing. The stock is pretty flat. Like a 5-year return of negative 13% is pretty much nothing. It has done nothing. However, what has been really good is that it has had a lot of short-term rises. So covered calls have performed incredibly well. And because I was bullish on Kraft Heinz for a very long time, I was getting income from covered calls and upside growth. Recently, I have not been in Kraft Heinz, and funny enough, I ended up selling it around $32 and completely getting out from basically the worst return that Kraft Heinz has had in the past 5 years. Yeah, I was really good with just understanding where it is in its cycle here, but I did end up selling it here from technical analysis. So essentially, Kraft Heinz has had, for me and my community, it's had a positive return plus covered call income plus dividends. So let's call it a 0% return, dividends 6%, and let me show you now what the covered calls can look like. Let me just show you a simple covered call going out 90 days, super simple strategy, and it's gonna probably wow you, okay? So we don't have a 90-day expiration. We have September 19 right now, which is 4 months. Not a big deal at all, pretty much same thing. So if we go to sell call right now, right, and you were to buy Kraft Heinz at $26, you can see here how even if I sell okay, so it depends. You can sell a 27.5 here, which would be kind of high delta. You can go for that high income, which pretty much would be a really good play. Or you can go for a 30 strike expiration, which would be a little bit on the lower delta. Interesting strategy is you can actually do both. So 27.5 is a little too close. It doesn't really give you much upside, although you still get over $1 upside. Whereas $30 is kind of too much upside, and Kraft Heinz probably won't go to $30 that fast in this example. In real practice, I don't think it'll go up to $30 that fast. What you can do though is you can mix it up. So you can go 27.5, you can go 30, you can open up both options. Interestingly enough, you can also create a custom order. So you can actually create a custom order here. Let's say that I'm like pretty sure that 27.5 is good, but I want to have a little bit of 30. So you can actually go for a ratio like 4-to-1. So I can open up 4 27.5 covered calls and then 1 30 covered call. And yeah, essentially I can collect like $400. And I'm just showing you like a variation. Let's just keep it super simple. And let's just say we're going to go with our original option, which is just a 27.5, right? So within like 100 days, essentially you're going to get $92 worth of credit, which is actually like a lot of money, because $92 that you're collecting is the premium that you collect. You still have upside of $1. So it's really like $2. It's a little over $2, but let's call it $2. And $2 on $26 is like 7% return. I'll put up the math here on the screen right now. I'm just gonna ballpark it right now. But $2 is roughly 7.8%. 7.8% is my guess, right? So a 7.8% return in 100 days, essentially if you were to duplicate the strategy, it would be like over 20% in a year, right? It would be like 22, 23% in a year. And I'm not even calculating the dividend. So like literally this is safe stock, slow return, low volatility, but you have over 20% return using covered calls, which is wild. Like it's absolutely wild. Which is why I like Kraft Heinz, because of all those different factors, right? When you're looking at dividend paying stocks, I mean, here's more examples. A lot of people like to do this. They like to go for stocks that have a dividend every single like month. That way, like in January, they get TSM income, and then Procter & Gamble in February, and then AVGO in March. Walmart would be in April. I have a huge Walmart position, by the way, and I am running a lot of Walmart covered calls. I love Walmart. I like it because they are improving their business through the grocery section. So they're bringing in people with groceries. Obviously, that's a consistent income because people have to buy groceries. And then once they come into Walmart, they're of course, buying other things. So their average order value, or their AOV, is going up. So Walmart gets you in the door, and then you buy other stuff, which is amazing. So I have $1 million in Walmart, and I'm up like $267,000 on Walmart, and I have covered calls that I'm selling. So despite Walmart being in the money at $96 and my covered call here is at $95, I'm still up. I'm up $6,000, and I continuously roll this higher, which we will talk about in this retirement course, rolling. I'm essentially owning Walmart, a lot of it, selling covered calls, generating income, and rolling those options higher and higher as needed. So freaking amazing income strategy. So yeah, May would be like Verizon, June is Home Depot, Nike in July, Caterpillar in August, ADI in September, and so on and so forth, Starbucks, Microsoft, and etc. Yeah, you can absolutely look at that. There's also a stock O, Realty Income, which already pays you monthly dividends. But
Look, I honestly wouldn't get too crazy about looking at specific months, because although this is exciting and it's like, okay, this month I get this and this and this, it's fun. At the end of the day, all you really care about is growing your wealth, growing your income, and having enough money. So you don't have to do specific months, because you can just always take out money out of your portfolio, because selling options is already that monthly income that you get anyways. But if you look at dividend paying stocks, you do create a double dividend, which is predictable income, which is like double income. And it's just very heavy income for those that are in retirement or looking to retire. So if you have a good nest egg, then this is literally like the best strategy for safe income. So again, I already went over everything, but here's a quick rundown before we go into our next section. So the steps are: buy 100 shares of a solid dividend paying stock. Think about reliable blue chip stocks, Microsoft, Apple, JP Morgan, maybe it's utility stocks, etc. Sell a covered call against these shares. Choose a strike price slightly above your current stock price. Go for 30 to 45 days, but you can also go out 3 months as the example that I showed you. So we can also go over more examples, because I essentially want to show you Microsoft, because it's not just double dividends. Whenever you're doing this strategy, even if a stock does not pay a dividend, I still want you to see and recognize good opportunities. So year to date, Microsoft is up 5.86%. And it does look like it's kind of peaking a little bit here in the short term, like we're at an, kind of an all-time high again as the market is recovered. And we can see here that for a very long time, Microsoft has not been above this level. So, it's difficult, because you don't want to have cash and just do nothing, but also it can be a little bit concerning when a stock goes up a lot like this. So what you want to do is you just want to go for an aggressive covered call. You want to go for income. You don't really care always about the growth of a stock, its price, because if you get good income, then you're good, right? Here's a 30-day option, a 1-month option. You can go right at the money. You can go right at the money. Boom. So the reason why it's so powerful is the delta is high. This is a little bit unorthodox, because I usually teach 30 delta and upside, but I'm giving you lots of variations, because this is the only course that you need to understand how to retire. So I'm giving you different deltas and different mindsets of option examples. So Microsoft, if you go for 450, it gives you no upside in the stock at all. In fact, it's in the money. So Microsoft's a little bit over 450, but that's fine, because the break even here is 462. So you're still getting $12 of upside, right? Of money that you can make, right? If the stock goes down, you still have $12. So you're fine, right? You're making over $1,000 here in profit. You're making $1,155. If it goes up, you're not going to get too much of really anything that Microsoft goes up, but you got over $1,000 in income for a month. And if Microsoft goes down, that's a really good scenario, because while everyone's losing money, you have a really nice cushion. Right? You have a cushion and you're not really losing money because you've collected premium. And actually, it's really good, because when a stock goes down and you have a covered call, you basically got compensated while everyone else in the world took on a loss. So you have a really big relative win. Relatively winning is better than absolutely winning, in my opinion, because the whole world adjusts to relative wins, right? So if the economy crashes 50%, you're flat. You're probably going to be pretty happy, because the money that you do have is going to be worth much, much more. But again, of course, it's also good to absolutely win and create that income. And that's what's going to happen. Obviously, we're not going to get a crash of 50%. So what ends up happening is you just make $1,000 on that position, right? So a reason why this is also really perfect is because if you are reinvesting money and you're putting in money from your job or your business, you can really reach retirement in 5 years. I mean, I'm in my 30s and I felt like I've had enough money for a while now, and I was able to leave America and travel, starting off in Colombia and learning Spanish and spending some time there and enjoying the nature there pretty early in my investing journey, I would say. I think it's absolutely possible for so many of you to, instead of having to look out 15 years, 20 years, to really look at that 5-year time frame and say, hey, I'm going to make my dreams, my wishes, my goals come true in 5 years. Take care of my family, travel, let go of my job, let go of my dependency on my boss, not have to do work that I don't want to do. So focusing on steady cash flow is the way to go, and avoiding the risky speculation is very important. And what works best is stocks that you're happy holding long term, really just combining covered calls, good quality stocks, dividends, and yeah, that's the double dividend strategy. So the key considerations, by the way, is ex-dividend dates. You do have to be aware of them, because if you have a covered call, the stock will go down by the dividend amount. But it doesn't really matter, since you have the stock, so it's not really a big deal. It really only matters if you're selling puts to get into the double dividend strategy, which is also another good strategy, is selling a put option
to get into the double dividend strategy. So before beginning the double dividend strategy, which is having blue chip stocks and selling covered calls on them, is selling a put over and over until you get assigned, right? So just be aware that the ex-dividend date is the date where you're guaranteed those dividends on that date if you hold the stock on that day. So the stock usually does drop by the dividend amount because it's paying out that cash, so it's going to be worth a bit less, which is about the dividend amount, right? So covered calls increase assignment risk right before the ex-dividend date. Again, it's really not a big deal, but I just want you to be aware of that. Now, in terms of account type, it's ideal to do double dividend strategy in Roth IRAs if you're American. For the Canadians, I think you have TFSA accounts. So you basically just a tax advantage account. It's good because a lot of premium, a lot of income does not get taxed. So yeah, it's amazing, right? Do not get taxed as much. In terms of risk management, you really don't have a whole lot of risk management, which is great because it's just really good stocks. So like long term, you don't have to worry about all this. There's short-term volatility, of course, but long-term, majority of stocks that you will own, Apple, Google, I love both of them. They have great valuations, which is pretty much going to look like that. So it's perfect. So you don't really need to do a whole lot of management. It's a super simple strategy. There is a little bit of double dividend rotation that you can do. So you can own several dividend paying stocks and you can have them in different sectors. Okay, you can also rotate covered calls month by month across different holdings. So some months you may say, hey, I don't even want to sell a covered call. I'm just going to let this stock ride, which I do all the time. I have successfully done that with SoFi, where I was doing covered calls, but for some time I said, no, I don't want to do a covered call. I'm going to let the stock ride. So that's also amazing. And yeah, overall, just dividend stocks end up being more stable. So yeah, I'm just going to skip over some of that. And now I want to jump in to the wheel strategy. All right, guys, let's talk about the wheel strategy. The wheel strategy is a fantastic strategy. It's the #1 strategy that has absolutely changed my life, changed the profits that I've made. And I would say the wheel strategy is the #1 strategy that you have to know, especially how to manage it, because that's very important as well. Now, here's my portfolio. What I want to do is I want to give you guys the theory, all right? I'm also going to give you the practice, the real examples, and show you kind of what I'm doing. Let's start off with kind of like my stock selection for the wheel strategy. So my stock selection here, a lot of my sell put options are part of the wheel strategy. So you'll see here I have Google, American Airlines, Archer, Palantir, Sweetgreens, Snapchat, Target, XLC, XLY, and then here's other parts of the wheel strategy. So to sum it up, like the wheel is selling puts and covered calls, and there's a specific way of doing it, of course, but it really is just that simple. It's selling puts and covered calls. So as you see, a lot of these sell puts are like the beginning of the wheel strategy, and then the covered calls. We'll go over covered calls in a little bit, or like the second part of the wheel strategy. Now, what I like about the wheel is really you're selling puts for premium, okay? And then if you're assigned, you don't mind getting assigned. If you're assigned, that's fine, cool. No problem at all, right? All you have to do from that point is start to sell calls. So here, sell calls, collect premium. So you get paid premium on the selling put side, like the beginning of the strategy and entering into the stock. By the way, if you don't get assigned, cool. If you do get assigned, cool. So either way, either you're in step one, right? You're in step one here, selling puts, or you go to step two, selling calls for premium. So either you continue to make money in step one, or you move over to step two, and then you make some more premium. Now, if you are assigned here, then you will make profits, and you will be forced to make profits in a way. But I'll talk about managing the strategy, even though it's good to be forced to make profits. So the wheel strategy is sell puts, sell calls. If assigned, you really just restart the whole process again. So you restart the wheel strategy from the beginning. So how it works is sell cash secured put on a stock that you'd be happy owning. If the stock stays above your strike price, the put expires worthless. You get to keep the premium. If the stock drops below your strike, you get assigned 100 shares of a stock that you want to own, right? So this strategy is very important to sell puts on stocks that you want to own, and then sell a covered call against those shares, generating income. If the call gets exercised, your shares are sold at the strike price, and you repeat the cycle by selling another put option. And that's the wheel. It continues in circles, and it's just a system, it's a process, and it's basically a 3-step income loop. So I'm gonna give you an example right now, a more hypothetical one, and then we'll get into like a real one as well, or many real ones. So let's say that you have Amazon at 175, and I want you to look at the screen because you will learn super fast with these examples. I'm gonna give it to you in multiple different ways, so you have learning across seeing, then me doing, and then you yourself repeating. So using Amazon at 175, sell a 170 put 30 days out, collect $2, which is $200 in total, because each option is 100 shares, so it's $200 total. And then 2, if Amazon stays above 170, you keep the premium. You just repeat it, right? So that's going to happen a lot of the time, especially if you're going for a lower delta option. 3, if Amazon drops to 168, for example, and you get assigned, well, your effective cost is 168, so you didn't really lose any money. Then it's sell a 175 covered call, collect $2.50, right, in premium. If you are assigned, right, so let's say you do get assigned, then you sell a 175 covered call. Your average is 168. So worst that can happen is you lose your shares at 175. Your average cost is 168. So you would make a profit of $700 plus you also get the 250 in premium. So you also collect premium. So again, just super cash flow system. Amazing, amazing cash flow. If Amazon stays under 175, nothing happens. You keep your shares and the option expires worthless. And then you continuously sell more and more covered calls. Now, if Amazon rises above 175, your shares will get called away. And again, if they get called away, you have a $7 share per share profit or $700 in total profits on the stock. Don't forget, this is very important, 250 from the covered call, right? And then you also made 200 from selling the put to begin with. So, let's say that this wheel strategy ran in full circle one time, your profit would be 250 plus 200, which is 450, plus $700, which would be $1,150. So you would have $1,150 worth of profits that you would collect. So $1,150 total profit on the wheel by running it one full circle, right? Let's say that, for example, you, instead of running it in one full circle right away, let's just say the stock goes, you don't get assigned at first. You sell a put, you don't get assigned. Well, you just collected $200 in premium right here, okay? 200 premium is yours, and then you sell another put option. Let's say it's another $200 in premium. You just continue on that way. You collect $200 over and over and over again until you get assigned, and then you're doing the covered calls portion of it. So it's many 200s and then basically many 250s, right? So that's pretty much how it works. If you don't get assigned, if you run one full circle again, it's $1,150 in profit. Okay, and this basically never stops. You follow this formula of put, if you're not assigned, repeat. If you do get assigned, okay, sell covered calls. If you don't get assigned on covered calls, repeat. So basically, you're either repeating continuously step 1, or you got assigned and you're repeating continuously step 2. And then if you loop out of step 2, which is you get assigned, then essentially you're starting the full circle again. All right. So I think this is a strategy that a beginner can follow, an intermediate can follow, even advanced traders. They realize that there's really nothing better than the basics. And that's why I think this free course really weighs in gold, whatever that saying is, because you don't have to get complicated to make stable profits. You can really stick to a consistent formula like this and repeating that formula without really even having to get into the advanced strategies or the risky strategies, and you can generate a full-time income on this. So again, this generates consistent income monthly from stocks that you're fine owning. Again, very important point. Biggest mistake I see is a lot of investors are doing the strategy on stocks that they don't want to own. So it ends up being bad because they get assigned and then they get nervous and then they get out of the wheel strategy, right? So they close out sell put, they say, I don't want nothing to do with this. And then they lose money because they don't like the stock that they sold the put options on. So the reason why this is safe and why it does work is profits will really roll in if the stock goes up, right? Profits will roll in even if the stock stays sideways, and it's even acceptable if the stock drops moderately. You will still make money because, again, if it drops a little bit, then your puts will get assigned, okay? Your covered calls, if it drops a little bit, well, they're making money, you're not getting assigned. So this is a viable strategy for a majority of the time in the market. Majority of the time in the market, by the way, is markets are going up over time. That's just what happens. GDP grows, the economy grows, more goods and services are being sold in America, and America's growing economy. And it has been for a very, very long time, albeit it's slowing down a little bit right now, and we do have a lot of debt in the country. It is still a growing economy, and that's why the stock market continues to expand and grow in valuation, just because of the passage of time. So given that, the wheel strategy on a long scale is going to be successful. Now, it can be unsuccessful. Let me talk about the risks of the strategy. Is if you get into some really big bear markets, you will have a more difficult time running this strategy because very big volatile swings can affect this strategy in terms of it being difficult when you sell a put to sell covered calls above your cost basis when the market comes crashing down. However, I just want to point out that if the market crashes or comes down a lot, then everyone else has lost tons of money, where the wheel strategy will actually preserve a little bit more of your money and it'll lose less money. So it's still a relatively good strategy even in a bear market. The only caveat is you may not be able to sell covered calls. So you may have to wait a little bit. And it's a case-by-case basis. And again, I do one-on-one coaching because the market's very unique. Every time it goes down, there's a specific reason. And every time we're going to go up, there are specific stocks that outperform the market. And it's pretty much my job to help individuals find and pinpoint those opportunities and take advantage of those opportunities disproportionately versus the market, right? Because even a small advantage can really add up. Even if you make an extra 1% per month than you would have over a year, it's compounded over 12%, right? So 12% on 100K is over $12,000. Over a decade, compounding, you're in multiple six-figure range. Like you will have a multiple six-figure result from just the 1% beat in the market per month. It's such a huge difference when you compound over time, because time is really one of the biggest important factors in the market. So the wheel strategy is a good strategy as long as you have time in the market. And again, the only major risk is stocks come crashing down far below your strike. But even then, premiums will really soften the loss. So there was a lost decade here. And this is a chart that one of my analysts here, me and him, we built these slides. You can see here that one of my analysts said that basically a lost decade here, even in a lost decade, you still make your money back eventually. And, it can be very weird to see a lost decade. I don't really expect one to happen, but they have occurred in economic, there were economic periods where that did happen. But again, that's like a very small percentage of the time and everyone will be affected by it. So option trading is not going to be to blame if we have bad economic times. But yeah, so some of the key principles is don't avoid assignment. You really want to plan for it. Okay, so this is a different mindset shift. Instead of avoiding assignment and being afraid, hey, I'm going to get assigned, instead plan for it. Hey, I'm going to be assigned. When I'm assigned, this is the price I'm going to be assigned at, and then this is the price where I'm going to be selling covered calls at. Pay attention to the technicals. And I do talk about technical analysis in my 6-hour course. I have a 6-hour free course as well on YouTube, which we'll put in the description, we'll put at the end of this video. But you can also go to my playlist, and I have a folder of courses. Courses take months sometimes to plan and build, so I think they're better. I can pretty much guarantee you my free stuff is better than everyone else's paid stuff. And I know because a lot of people on YouTube, option traders, have been my students. A majority of them have been my students, and I have trained them even on the option coaching side for YouTube. So I can tell you that my free stuff, my goal right now is to make my free stuff better than everyone's paid stuff. So you don't really have to buy anything. This is one of my kind of gifts to our community here, because I think it is very valuable information that can really change your life. So yeah, don't avoid assignment. You're fine. You just run the wheel strategy. And you also want to run this on stocks that you see a long-term view on. So avoid junk penny stocks. That stuff is trash. Avoid stocks with really high valuation and extreme volatile names. So I'm not chasing volatility. I'm chasing consistent returns. So you want to look for stable, strong companies. Strong balance sheets would be great. And for example, Microsoft, Apple, Amazon, Google, Palantir, Mag 7 is great because Mag 7 is growing a lot. They're growing top line and bottom line, so that's very important. Now, in terms of strike selection, you want to sell puts at a price that you'd be happy to buy the stock at. And you want to sell calls at a price that you'd be glad to sell your shares at. So think of it like basically limit orders. You get paid for placing a limit order, though, when it comes to options. So it's pretty crazy that more people are not trading options. I think it is becoming more popular. More people are realizing this is a very profitable way to generate income into retirement. So yeah, you don't really need a huge account either. You can always start small. And I would say starting small and building up your portfolio is also a very good experience. And that's what I did specifically myself. I started with a $2,000 portfolio, and I was, 19 years old, or maybe, I was around 19 years old. I was still in college. I was studying finance, and I had gotten my first internship on Wall Street. I got very fortunate that I did a lot of networking. I asked everyone for a job, and I was an intern on Wall Street, my first job. I had many Wall Street jobs. I worked at hedge funds as well. I worked at Goldman Sachs. But my first job was in the option department on the New York Stock Exchange for a small market making fund, essentially, or prop firm. They have many different traders there that are trading different instruments. But I was on the option pit. It's called the option pit, and I was looking at the option traders making their trades and managing their risk. And it was very interesting. and I had started with $2,000, and my goal was to retire. Just like you're watching this course, I had the same goal as you. I was just like you. I wanted to retire. I mean, I was young, but for me, it was I want to have enough money to not live at home. I wanted to have enough money to go on dates with beautiful women. I wanted to have enough money to afford living in a nice place, having a nice car, etc. Right? I was very broke when I grew up, and I was broke until I was broke for a while. But it did really change when I started trading options and learning on Wall Street. So that first internship, I had $2,000, and I started trading very small. Was buying some options, which isn't really the best for your purposes. If you're looking to retire, option buying is really that higher return, but higher risk. But at the time, I was higher return, higher risk profile. So I was doing a little bit of option buying. And then my first year, I wasn't really that successful. I did turn $2,000 to $7,000, but I was adding a little bit of money. This is a decade ago, over a decade ago now. So I was adding a little bit of money. And then that first year was $2,000 to $7,000, small results. Still in college. And then I continued to build up the account very slowly. I got from $7,000 to $17,000. And I just continued to build. I had another internship. That internship was Goldman Sachs. And then at that point, I had saved a little bit more money through learning at Goldman Sachs. Then I got up to $70,000, and then I had another internship. At this point, it was like my final year of college. So I had another internship where I saved more money. And then when I left, I had a hedge fund. I worked at a hedge fund. But I quickly realized that all these Wall Street hedge fund jobs were awful. I was coming into work super early, staying super late. And to be completely honest, I was learning very fast. And I felt like even at Goldman Sachs, I didn't have that much more to learn. The job was not really teaching me that much. So I was very glad to leave, go on to my next job and my next job. And I figured out a solution for getting to retirement fast in my 20s by stacking multiple different jobs, the experience from them. Goldman Sachs, my first hedge fund, second hedge fund. I also worked at a market making firm, worked as a financial analyst. And when I started to combine technical, fundamental, secret strategies that I've learned from internal resources at hedge funds, that I can't mention all of them on YouTube, but a lot of them I teach anyways here indirectly. You still learn from me. And when I put it all together, I finally had experience under my belt, and my account went from 70K. Essentially, I added a little bit of money. I had a big pay. I forget what it was, 30 grand I made. I went from 100K, and I started my YouTube journey at 100K. It was crazy because the numbers were even and round and easy. 100K to 700K in 2020. It was 2020. It was on YouTube. You can look it up. You can go to my oldest videos 5 years ago. I had a video where I made $14,000 in 1 month. So that was my first month in the 100K. I had $14,000, and then it just pretty much skyrocketed from there. I was doing a lot of some of the strategies I'll teach you later on in this course. Put credit spreads were a big contributor because I was doing put credit spreads on Tesla stock. So I was selling put credit spreads, on Tesla stock. I was also using Leaps. I have some Leaps videos on this channel, and I have a course coming very soon on Leaps. That's my next course. So make sure you are subscribed to this YouTube channel, because when I release these courses, they are life-changing information. Plus, I have lots of updates anyway, so make sure you subscribe to the course with notifications. But yeah, so I grew tremendously with the strategies that I'm going to continue to teach you in this course. And then at 700K, it was crazy, because at that point, it was very easy to scale from 700K to 1.5 million. And then my returns did taper down a bit. I'm still making 4% a month, but I tapered them down because when you have bigger money, you don't really want to take on the same risk. And yeah, psychologically, you're just not going to take on the same risk, right? If you have $1,000 to your name, of course, you're going to go to the poker table and, you're going to, whatever, you're going to take on big risk. But if you are a professional gambler, and there's many rich professional gamblers, you're a millionaire, you're not going to come to the table with all your money to play poker. You're going to come with 5,000, 10,000, 200,000 if you have multiple millions, right? So it's all about bankroll management. It's all around risk management, diversification, position sizing, asset allocation, financial planning. These topics, by the way, they're not covered on YouTube, and I don't cover them. They're too boring and nobody will watch them. People will click off the video. These are the resources that I have inside my Discord community. They're just too boring to talk about. They're not appealing to the YouTube algorithm. So we'll continue on with my presentation, but I wanted to go a little bit off tangent. I'm sorry if any of that was not fully on topic for you, but I wanted to really teach you multiple levels of option trading mindset journey, so you know that you can do the same thing, because my journey was long but fruitful, and I think you can shorten that journey yourself. So here are a few of the stocks that I'm trading right now in my portfolio, and I think that it's very easy to scale up with these names. Archer, Snap, American Airlines, HIM, SoFi. These are great for the wheel strategy, and they're very beginner friendly. That, by the way, that was like a whole timestamp of like a story there, maybe, I don't know. My story, I guess, because it's very important for sales. What's great about the strategy is there's no guessing market direction, there's no need to gamble, and it's just repeatable and disciplined cash flow system. So I want to continue the wheel strategy here with some more examples and management specifically. So wheel management matters very much long term. It's not just the basic cycle. So when the stock drops after selling a put option and you get assigned, it's expected to happen. You don't mind getting assigned. So you just start immediately selling covered calls, even if the stock is below your original strike price. Now, each premium that you collect lowers your break even. So it's great to not get assigned, actually. So you can just continue selling puts, and it just continues to drop your average cost. Like, check it out right here. If you sell a $100 put option, for example, here's how you ladder down. This is amazing. You could just ladder down over time. So you sell a put option, you get $100, now your average is 99. So then you sell another put option. Let's say it's a little bit more volatile, or a couple more weeks. Instead of 1 week, it's 2-3, and you get $200 in premium. So you don't get assigned here, now you sell 200, and if you don't get assigned here, essentially your break even is now 97. You go sell an option again. All of a sudden, your break even is now 95.50. You can see you can ladder down over and over again by selling put options, and you can actually, in theory, get your average cost down to 0 if you do it many, many times. Of course, probably that'll take 100 weeks if you don't get assigned. Of course, it's pretty rare to go down to 0, but in theory, it can happen. And over time, when you start collecting covered call income, of course, that also takes your average cost lower. So if you've been doing this long enough, your average cost is really nothing. It's like buying a property in Miami a decade ago. You buy it for $300K, and now the rent now it's worth, let's say, now it's worth $1.5 million, and the rent is $10,000 a month, right? So that's crazy. That's a great investment, right? You turn $300K into $1.5 million. Now you have $10,000 a month in income as well, and yeah, that's the same thing with option trading. You don't have to physically own the real estate itself. You're just owning. You're not really owning anything with the option, right? If you get assigned, then you are owning. When you're selling puts, you don't own anything at that moment. So yeah, you can repeat the strategy monthly. Slow, steady income, even in down markets. Even in down markets, you can make really good money. And even if the premiums are tiny, you just wait, and you don't need to really do anything. They just add up and they start to snowball. And it's the best strategy because it just snowballs on itself as you build up capital and momentum in your portfolio. So, put expires worthless, you get to keep the premium. In strong markets, selling puts alone can pay 1% to 2% a month very easily, but you make a lot of your profits from the upside of buying stocks and selling covered calls. Now, in volatile markets, believe it or not, you'll actually collect more premium. So in strong markets, it's 1% to 2% because everyone sees there's a bull market, but in volatile markets, you can see premiums skyrocket. You can see premiums 4 or 5% on specific stocks, even more, right? You look at Tesla, it could be a lot more because there's higher implied volatility, and that higher implied volatility is going to drive up the premiums of the options. So if you are assigned and stocks jump right after, you don't really need a rush to sell a covered call. You can just enjoy some of the gains. And oftentimes what happens is you get assigned on a Friday, right, or Saturday morning, really, for options. 4 p.m. they close, but there's a little bit after hours. Monday, you're assigned 100 shares and the stock's up. So you start the trading day and you're already up a lot of money because the market's up on a Monday. So it can be very, very lucrative to run this wheel strategy simply by some of the Mondays being big days. So it's very advantageous. Now, even with some volatility, you just let the price settle. Maybe you sell higher strike price calls later. So maybe you just wait. You look at the stock behavior, and maybe you don't have to sell right away, right? So for me, what I do is if I see a stock going up, I'll just wait, and I won't really do too much there. Now here's a screenshot of my portfolio. This was actually a little bit of time ago, but there's just some examples here. Now we're in June 2025, basically, as I'm making this video. But again, like I said, these courses take sometimes a couple months to build and edit and get these out to you. So here's an example from May, expiration May 2nd. I had several options here. Robinhood, where I made money selling puts. These are all my Discord plays. PayPal, we made money. Snap, sell put. XLK, excuse me if this is a little bit blurry, but XLK, we had some positions here. And essentially this is just, again, running the wheel strategy. And yeah, there was some volatility in the market, but these positions ended up doing very well. Yeah, so we want to rotate out stocks if they get too volatile or expensive. That is very important, because if it's not really fitting your criteria and it's just bouncing around a lot, sometimes it can make sense to just cut that position, but it really is rare to have to do that. Only in cases where the stock fundamentally has changed, okay? So in terms of scaling the wheel with more capital, you just run more of the wheel. So you just run it on multiple stocks, multiple contracts, different stocks at different phases. So basically you just really steady, create layered income. You have income from Amazon, from Nike, from SoFi, Palantir, etc. And you sell shares and you rotate to new names as needed. So if a position becomes big and you keep getting assigned, yeah, you want to still pay attention to your risk management and position sizing. So it's important that, staying flexible, you control the wheel. So if you don't want to get assigned, you don't have to. Okay, now we're in the portion of this course where we're going to talk about building a small portfolio. How do you retire if you have a small amount of capital? Well, let's say you have a large amount of capital, but you want to start off with small amounts of money, really learn option trading. The best strategy will be the smaller account strategies, such as credit spreads. Now, credit spreads are higher return, a bit higher on the risk, and we'll talk about what a credit spread is, how to open one, how to manage one, how to close one, okay? It is pretty safe income, especially if you diversify and have many credit spreads open, and you can profit a lot of money on a monthly basis with credit spreads. You can also use them in shorter term durations as well. So a cash secured put and a covered call, it needs a lot of capital, right? We've covered those two. You need to have 100 shares if you're doing covered calls, or simply selling a put option, you have to be ready to buy 100 shares, right? Well, a credit spread is a lot lower capital, and we'll go over some examples. Essentially, you have a defined risk and a defined return with a credit spread. Let's go over an example on, say, Amazon, okay? So I'm gonna open up Amazon right now, and we're gonna do an example. So over the last 1 month, Amazon is up. It's very stable, right? It's actually been very stable from May 12th to basically May 30th. It is incredibly stable. Okay, so given that it's so stable, let's say that we want to make income and we believe that Amazon will not fall under 200, right? You can see here that it's holding steady at 200. Okay, what we'll do is we'll go to trade Amazon options, and the first position I'm going to show you is going to be a put credit spread. All right, so I'm going to go to sell put option. So a put credit spread is actually pretty similar to selling a put option. Okay, so it's very similar, and now that you understand how to sell put options, a put credit spread it's kind of like the cousin in a way. Okay, so I'm gonna go for an expiration date that's gonna be about 30 days out, all right, the end of June. And you can see here, we're gonna start off by selling a put option. We said that 200 is the level that we believe that Amazon won't go lower than, okay? So I'm gonna do the 200, I'm gonna sell this, and you can see it's a short put. Now, a put credit spread, all it really is you're selling one put option, right? You're collecting income, and now you're gonna go to buy, and you're gonna buy a put option, and this put option that you're buying is going to be lower in strike than the one that you sold. So we sold the 200 strike, we got $400. Now we're going to buy the 195 strike, and we're going to spend $276. And what is the benefit of doing that? Well, if you're selling a $200 put, you have to be ready to buy at 200. But with the put credit spread, you don't have to be ready to buy anything. The reason why you don't have to buy anything or be ready to buy anything is because, well, you're covered in the sense that if Amazon goes to zero, you don't really care per se, because you can't lose any more money than it going down to 195 since you were long the 195. And that's why you'll see right here,
that if Amazon goes down essentially right here at 195, you really can't lose any more money. You would lose all of the money that you, all the capital here, okay? And the capital here specifically, I'll break it down for you step by step. Look, the difference here is $5, right? You can lose only $5. You can't lose more. You can only lose from 200 to 195, okay? Now, the reason why Robinhood here is saying 361 is because although you can lose up to $5, we're collecting $1.29. So really, you can only lose the difference of $5 minus 129. So this strategy right here is very limited for risk. You can only lose $360, and the maximum profit here is $139. So you're able to collect this income like selling a put option, but if Amazon drops below 195, you don't really care. Of course, with this strategy, it's a bullish strategy. You want the stock to stay above 200. So this is a put credit spread, and it makes money as long as Amazon stays above the put that you sell, which is going to always be closer to the money. So it's a closer to the money put option. So a credit spread is collecting a credit or getting paid by selling two options. It can be two puts or two calls. And I just showed you an example of selling two puts. So you sell one option and then you buy another one at a different strike price. It can also be the same strike price, but that is a little bit different of a strategy. So it's basically selling one option that's more expensive and then buying a cheaper option to kind of cover your butt in a way that is going to be less expensive. So one option you make money, the other option you protect yourself so you have a limited downside risk. And the net credit that you collect is going to be upfront, and that is essentially your max profit. Now your max loss is going to be the difference in the spread, right? So the difference in the spread is 200 minus 195, which is $5, but it's also minus the credit that you received, right? So you got paid to enter the position, so you can't really lose $5 because you've gotten paid, so you only lose the difference with the $5, and then if you got paid $1, then you can only lose $4 total. So here's an example that we'll have on the screen. Let's say Google, okay? Google's at 150. If you sell a 145 put for $1.50, and then you buy a 140 put for 50 cents, you get a net credit of $1. Right? Your maximum profit, therefore, is $100. And your maximum loss, because your spread is 145 and 140, is $5, right? But the max loss here is only 400 because it's the total risk of 500 minus the maximum profit of 100. So your maximum loss is only 400. And the reason why this is so good is because although the risk to reward ratio may not seem good, if the option is out of the money and it's unlikely to happen, it all depends on the odds, right? So what if I said that you win $10, but if you lose, then you lose $1,000. You may tell me right now, wow, that is a stupid bet. That's stupid. But I didn't tell you what the bet is, okay? What if I told you to win $10 and to risk $1,000, right, is for lightning to strike your neighbor's house in the next 2 minutes? Now you're like, wait, $10 for $1,000 risk? Yeah, I'll take it because like many 2 minutes have gone by and my neighbor's house has not been struck by lightning, right? So it's all about the odds. If the odds are in your favor and they're good, then you're fine. If the math makes sense, if the math is mathing. I'll show you more examples and I'll show you the risk management, I'll show you the probability. But all I want you to start thinking about right now is if there's a max profit of 100 and the max loss is 400, you want to make sure that this makes sense for you in terms of there being a very small chance of this happening. So for example, let's say that there's a 10% chance of losing and a 90% chance of winning, right? So here's what you do, simple math, okay? Nothing too complicated, just simple multiplication. If there's a 90% chance of winning, right, then you have a 90% times $100. So you're expected to make $90. That's your expectation. And if you lose 10% of the time, 400 times 10% is 40. You have an expected profit of 90. You have an expected loss of 40. Your expected gain is $50. So in this example that I'm giving you, you're every time you open this position, probably going to make $50 on average over the long term. And that's called expected value. What I like about this is there's defined risk. You know your risk up front. You know you can lose 400. You know that you're going to make 100 up front. And so you have a defined risk, and that's very nice to know because you're not having unlimited risk. You're not having potentially a lot of risk, you know exactly your risk. And what's nice about this is you're only risking $400 in this case to make 100. So very low capital required, and it's very good for small accounts. Also, it's very versatile because you can actually go bullish, bearish with these strategies. So for example, this is a bullish strategy. Going back to the Amazon put credit spread. That's why you can see here that if it's above 200, you make money. But even if Amazon slightly goes down, you don't care. You're still here in the green, in the profit zone, right? This is what's considered a bullish strategy, but we can also say that a put credit spread is a neutral strategy. Okay, this is a neutral strategy as well. Now, I want to show you another spread, except this one, instead of being a put credit spread, which, by the way, I do have videos on put credit spreads as well. So if you think I'm going a little too fast in this course and you want more information, in the description, I'm going to have a specific shorter video on just put credit spreads and some of the more specific shorter videos that I have on those topics. But now in NVIDIA right here, you see it's at 138. They've had earnings, which, by the way, I made a lot of money in my Discord. A lot. Because I said pre-earnings, we should be buying leaps, we should be buying calls, and we went into growth mode here, into buying mode. We've been making money hand over fist, guys. NVIDIA has been great. Now, what I want to say is, given that NVIDIA has had a good return, very good return short term, especially in the 1 month, it's had 32% return. I can show you a bearish strategy, a spread that's bearish. So this bearish strategy that I can show you, right? So let's say that we think NVIDIA has squeezed out a lot of momentum in the short term, and we believe that it's going to stall out here in the short term. We're probably not going to go too much higher, right? Because we just had earnings. Now the new news is baked into the stock price. We don't think it's going to go above 145, which is, $7 above the current level. And in 7 days, that's really not that likely to happen. And if I expand this option, you can see the delta is 0.25. So there's really a 25% chance that this may happen, right? There's a 25% chance that it'll go above 145 and a 75% chance that it will not, okay? Crazy volume, absolutely crazy volume. The volume here is 81,000 contracts have been traded, so a lot of contracts, okay? But here's what it would look like. You can sell a call option, right? And you can't really sell a call option by itself. That's called a naked call option, which is very dangerous. I'll never recommend it ever. Not even, well, I do recommend it for higher net worth individuals who have 500K plus, my one-on-one coaching. Sometimes I do recommend it, but for YouTube, for a beginner, absolutely not. Absolutely not. So look, you sell one call option and then you buy another one. This gets rid of your risk, and I'll show you an interesting variation because we are talking about small account portfolios and scaling them and getting to retirement with smaller positions. So you can go ahead and buy the 148 here. Okay, the 148 strike means that there's a $3 gap. So there's a $3 gap here. So the $3 gap means that you're putting up very little capital. And you can see here that the maximum loss is 244 on this trade. Okay, and that's because we're collecting, about, just call it 250. Okay, and we're collecting $50 worth of premium. Okay, so we get 50 bucks. And we're risking 250, okay? The risk here, you can see that this chart is reversed. So now this is a bearish strategy / neutral strategy, because if the stock goes down, we're in the green, we're good. If the stock goes neutral somewhere here, it's fine. We only lose money if NVIDIA skyrockets past 145 roughly, okay? And the reason why this break even is 145.56 is because we did collect some credit here, so that's why instead of 145, it's a little bit higher of our break even, right? So yeah, we start losing money if NVIDIA were to go up, and that's why this would be a bearish strategy / neutral, because the stock can go a little bit up, a little bit down, a little bit sideways, and it will be still okay. And that's what the amazing thing is about this strategy, is it should be a small portion of your retirement portfolio. So your retirement portfolio should be what I taught you before, which is selling puts, covered calls, and the wheel. But there is a place for credit spreads as well, and having 1, 2, 3% of your portfolio on credit spreads, absolutely amazing if you have a big portfolio. If you're scaling a smaller portfolio, then it's okay to have even 5 to 10% of your money on spreads. Just do know that they are, of course, going to be higher risk than the wheel strategy itself. So here the profit of 50 bucks and the risk of 250 is essentially a 1/5 return, which is a 20% return. So it's a 20% return in 7 days. 7 days gets you 20%. So you can see how this is a very lucrative strategy, but it is definitely going to be higher risk. And here we know that about 25% of the time, we can lose money on this trade, okay? So the odds here are very even, okay? They're very even odds just based on math alone. So what I usually do, and it is a case-by-case basis, in my Discord community and my coaching, I usually look at technical analysis. I'm looking at how high is the stock likely to go based off of indicators, okay? And if I don't think it can go higher, then this strategy makes sense. But if you just look at this strategy directly, it's going to be a very even money play, meaning that you probably don't have that much expectation to make money, okay, based on the math alone. Because, I mean, option trading, all the trades that you make are fairly even money. If there was a position that was just like massively mispriced, then of course hedge funds and traders would step in and they would exploit that opportunity, and that opportunity would be gone. So there's many methods of trying to analyze whether this is a good trade to make. But on a beginner level, let's back up. This is a neutral to bearish strategy where you can make money if the stock does not increase. And as you can see, like I said, a typical return could be 20% plus. You can make 20% plus on a successful trade. You can also run spreads on, you can run multiple spreads at once across different stocks. So you can have some put credit spreads, you can have some call credit spreads as well. And here is what a put credit spread looks like. Again, a put credit spread will benefit if the stock goes up, right? So a put credit spread, when you're selling a put, you don't want it to go down because then you start losing money. And you can see here a call credit spread is the exact opposite, what I just showed you an example of. A call credit spread, you don't want it to go up. You ideally want it to go down or stay the same. Okay, so this is great for income stacking without having to stare at charts all day. You open these positions up and then typically 1 month to expiration, just let them go. Let them do their thing, because again, these positions are neutral, so they benefit if the stock does nothing. So as time goes on, you are making money and you're able to close this trade really at any time. So you can close it early if you've made good profit. And my rule is on a put credit spread or a call credit spread, if I've made 50% and it's only been a week, for example, and it's a 1 month long option, then of course, 25% of the time is gone, but I made 50% of the return, so it's a good time to close that position for a profit. So a call credit spread versus put credit spread, let's talk about it. Two types of credit spreads are put credit spreads, which are bullish to neutral, where you sell a high strike price put option and then you buy a lower strike price put, and then you profit if the stock stays above the short strike. And another example is you do a Meta, say Meta's at 510, you sell a 500 490 put. You would want Meta to stay above the 500 put that you sell. Right? Now, a call credit spread is a bearish to neutral strategy again, and you sell lower strike call, but you buy a higher strike call to protect yourself, and you profit if the stock stays below the short strike. So an example is, let's say American Airlines is $11 and you sell a $12 call, and then you buy a $13 call. Well, you would hope that American Airlines would not reach $12. You would hope that it would stay below. So you would use a put credit spread when you're bullish, and that's why there's a little picture here of a bull. So a put credit spread is you're bullish, and a call credit spread is you are bearish. Fun fact, I was just in Estonia, and I tried bear for the first time. It was interesting. So let's talk about setting up a high probability credit spread. So you want to pick the right stocks, whether it's Apple, Microsoft, Amazon, Google, or Palantir. You want to pick a stock that has a good upside and good support levels. It's also very important, you can see here, I'm going to zoom in, is that you want a tight bid-ask spread. So Palantir here, 120, this example is from last month essentially when I made this presentation, but you can see the same rules apply. The bid-ask should be pretty tight, right? Here it's 670, 690. That's decent. That's not good, it's not bad, it's decent. Okay, Apple, for example, would have a much tighter bid-ask spread because there's just a lot of volume and a lot of traders trading it. Palantir just happens to be a little bit less of an efficient bid-ask spread, and that's fine. All that means is that you're just losing a little bit more money on slippage cost, which is, you're buying it at 690 and you're selling it at 670. It's like going to buy a gold bar for $690, right, at one jeweler, and then you go to the next jeweler and you say, I want to sell it. Was like, well, I'm only going to pay you $670, right? So that's the market, and that's because the jeweler wants to make money. Everyone wants to make money. So the jeweler that's selling the gold, they have a different buy price and a different sell price, just like a currency exchange, right? You go to exchange currency, there's a little bit of a difference, right? It's the same thing with options. There's a little bit of a difference here. Yeah, you're gonna have a $20 difference, which is, it's okay, but you want it to be tighter. So if it's $10, it's even better, right? High volume, Palantir has very, very high volume. So this is good, 7,288 volume. Now let's talk about strike selection. So you wanna aim for short options around 0.3 delta. That's my sweet spot. So when it comes to strike selection, as long as it's around 30 delta, it's good for selling options. But if you're doing a spread, then you want to go half that because a spread is riskier. So you want to give yourself more room for error with the spread. So it's better to go 15 delta for a spread. The best windows, it can for expiration, it could be 21 days up to 45 days, right? So I do have some students that were even doing 0 DTE trading where they expire the same day. It's more work. So for YouTube purposes, for simplicity, and typically for most students, I say we just want the passive income. We're going 21 days to 45 days. And shorter expirations do have less premium. They have a little bit more risk because you're not collecting as much premium up front, so there's not as much cushion. If the stock goes down short term, yeah, there's a risk and reward there. Now for longer, it's very slow time decay, so longer options are kind of safer, right? But they're also very slow time decay, so you get your income up front. It's very secure, but then it's more of a slow burn after that. Now it's very typical to risk $3 to make $1 because the odds are stacked in your favor for success. So the risk reward may not look good up front. There's also going to be many small wins. Very, very often it's going to be very boring. And usually when you sell out of the money options, the more out of the money you go, the safer it is and the more likely you are to win. But you're going to have those small wins, which I think is really good. You have many small little wins, which is essentially how a casino operates. You play some blackjack. The blackjack odds are 51-49. The house has a 51% advantage. So it's going to look 50-50, but the house is going to come out ahead over time. It's the same thing with selling options. When you're selling them, you're kind of like the house, and you're collecting small percentages of profit over long periods of time. So again, small percentage of your account per trade because odds are in your favor, but you still don't want to be caught in one big trade because that's not proper and safe risk management. One of the golden tips that I have is in volatile markets, focus on stable sectors. Some of those sectors are consumer staples, healthcare, utilities. You got Procter & Gamble, you have Kraft Heinz, Pfizer, Walmart. Some of these stocks are very safe. And as a final rule, don't force trades, wait for clean setups, see that there's good support, and essentially collect good premium. So your risk to reward ratio is very profitable and it's good. If you made it to this part, I seriously want to congratulate you because you're very few percentage of people in the entire world that has the attention span, the grit, and the ability to actually make it this far. So first of all, congratulations on that. That's rare. And that's already a huge sign that you're going to be very successful. As you know, it took a lot of time to make this free course, and I hope that you enjoy this free course. But I also want to let you know that if you're hungry to make more money, if you're hungry to get your option trading to the next level faster, and you don't want to go through a lot of trial and error yourself, I'd be more than happy to give you my trades, to have some one-on-one coaching with you directly, to have you part of my private community. And in this community, I do my live trading, I give trades, I answer questions, and it's where people share ideas. Option traders can make money. And this might be a fantastic opportunity for you. And if you want to apply for that and see if we're a good fit for you, it's a two-way interview to understand, is this program something I want? Is this something I need? Or is, maybe it's not a fit. Either way, I'd like you to click the first link in the description, submit your application, and learn more about the program that I have, the pricing of the program, and to see if, working together is something that we can do together and to build up your wealth. So here's to your success, and congrats again for making it to the end of the course. I'm super happy and I'm blessed that you made it this far. So thanks a lot, and that's really all I have for you.